the explorer spirit, how can we really tap into new things, continue being disruptive. We have 80 different nationalities at On. It's very important to have a diverse team because we have a very diverse landscape of customers.
Welcome to the world of decentralized finance.
With the surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
We could start to see continuation of the softer economic momentum.
The unemployment rate is inching higher. That should potentially be setting off some alarm bells at the Federal Reserve.
Unless we see the jobs market picking up again, it still looks to us to be an economy which is losing speed.
We can see payrolls as low as 150 probably, or as high as 250.
If we in fact actually get this very gradual decline in labor market pressure, I think that's actually quite a good outcome.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
From New York City for our audience worldwide, good morning. It is Bloomberg Surveillance. I'm Manish Kani alongside Danny Berger. It's not your usual lineup for Jobs Day. Politics, you have the two of us. Danny, it's a fascinating time to come into work on the 5th of July, just from the political side, but from the job side. This is the day that maybe the dual mandate really rises in ascendance in terms of the numbers that we're expecting on the non-farm payrolls. The whisper number stands at 185,000. Incrementally, people are coming down at the moment.
I think it is after a weak ISM data earlier in the week, the weakest for services since the heart of the pandemic. That's really emphasized the importance of this labor market data. You get a real sense that we see this weakening in the economy, but so far it's been in the high-frequency data, dare I say the tier 2 and tier 3 data. So this needs to be our North Star. It is something that we can really hang on to say, is this enough to cement any sort of Fed cut in at least September?
Well, it's going to be interesting to see what happens with the unemployment rate, whether it breaks above that 4% level. That's going to be critically important. And then for the consumer, how much do they have in terms of their spending power on real wages? Check in on the markets. The bond market had some virulent moves running into your shortened trading day on Wednesday. SPOOs are flat at the moment, 55.91. You are looking at record after record there. The Nasdaq made another all-time high. Euro-dollar trades at 108 as it looks as if the dollar is slightly more on the back foot at the moment, and you have 10-year yields. This is the critically important pricing point for all growth stocks and all markets. 433 is where we are at the moment. Again, what does it take for the bond bulls to be reinvigorated? There was a huge amount of burst steepening in the last 6 days running up to the July 4th holiday. 433 is where we are. You're going to need a heck of a soft number to take you down to 425 before you open a new bandwidth below that, and crude trades at 83.80 at the moment. So it really is, what does it take for the bond bulls to be reignited here?
I'm also interested in what difference does it make to this equity market, an equity market that's been led by really thin air. Piper Sandler dropping their coverage entirely of the S&P 500 earlier this week, I think is so telling. The fact they say for our clients, giving them a price target for the S&P 500, it's an exercise in futility because it doesn't tell you anything about this market. If you look at the rest of this market, Manis, it has been trading some of this economic weakness. So if we get a weaker number, does that fuel it? Does it continue to be the only thing you can buy at this point is NVIDIA?
Well, maybe what reinvigorates not just the growth. I mean, the growth narrative at the top is resplendent on its own. It's responsible for the free cash flow, it's got dividends, it's got buybacks, it's got everything that you didn't have in the year 2000. But in terms of the yield, breaking that 425 area, which was everybody's focus in terms of the market, you're going to need a softer number, and not just a softer number, but you're actually going to need the narrative to shift to the door opening to a September rate cut and trying to reaffirm 2 rate cuts for this market 2024.
You've had a little bit of that, right? Again, as I say, the high frequency data has pointed to this. So I can't help but wonder if the risks are asymmetric to hotter data, that potentially this is a market that is unprepared for what we got last week, which was the data rolling in higher than we expected, higher in a good way. Because we did look at JOLTS, that was confusing. We didn't know what to make of it. So we're entering this period of confusion, this push of pull of what do we trust more, our fear about the economy or fear of higher deficits?
Well, the fear of the economy is becoming ever more prescient and ever more real. You've got services dropping to the lowest level in 4 years. You've got manufacturing. We know manufacturing is under pressure, services under pressure. So incrementally, these negative surprises are coming. We had Goldman Sachs a little bit earlier, Peter Oppenheimer, saying the macro backdrop is softening. Their macro supplies index is negative. It's a question of whether that very, very left tail risk, which is the word or, which is not the or star, but it is recession, and whether that rises, not necessarily a full-blown recession, just as I've been saying through the morning, the double soft.
Yes. Well, let's be honest. The employment picture typically does not move in a linear fashion. And that's what it has been doing. So that is the fear. If we get a bigger tick up in unemployment today, something even remaining at 4% or going to 4.1%, is this the start of a nonlinear move?
And we will get to it a little bit later on as to whether this really is the put up or shut up weekend for the President of the United States of America. Will Joe Biden remain? He has a big interview on ABC today. We'll talk more about that in just a moment. The headwinds for Biden remaining on the ticket. Coming up, Prime Minister of JP Morgan as traders await the latest U.S. payrolls report. Jordan Fabian as President Biden heads into, as I say, this make or break weekend for his campaign. And Pooja Kumra of TD Securities after the big win for the Labour Party in the United Kingdom. But we kick off this Friday with the big story. Global stocks are trading near their all-time high. That's ahead of the key payrolls data. JP Morgan's Prime Minister writes this. Our high-frequency measures suggest a slowing in pace to around 175 to 200,000, but I think that is priced into all markets. I think the risks are skewed to the downside. Priya joins us now. Priya, good to see you. Very good morning. And thanks for working 5th of July. So the risks are skewed to the downside. The question is, how substantial a slowdown do you think we are going to see over the next 6 months?
So again, the day, I would argue end of cycles are always tricky because it's hard to sometimes disentangle the signal from the noise. I mean, the economy is, no question, the economy is slowing. Are we slowing to trend, which would be that 150 to 200,000 payrolls? Are we slowing below trend? Recessions always tend to be non-linear. I think what we see so far is we're slowing to trend. But can it worsen? It can absolutely worsen. I mean, there are some signs, ISM services, the JOLTS data, we're right at that inflection point, which is why I think this number is very important. If we see a number 150 or below, and I think we should also all think about what is break even. Historically, we would think 100,000 was break even, but with where labor supply is, maybe 200,000 is the new break even. So if we actually grow at 150,000, maybe that is that non-linear slowing. So, I think we're still optimistic that the soft landing holds, but I would say that tail risk, as we think about the risk to soft landings are all about risk management. There is this tail risk of reacceleration. I think that has been put away. There is the tail risk of a recession. And I think if we see a slowing, even 150, which, 5 years ago, I would say, 150 is fine. I would get a lot more nervous that things are slowing down. Maybe the fact the cracks in the economy, there are cracks in the economy in the low-income consumers. Is that strong enough that companies are starting to pull back hiring? So I think we're at that, I would say I'm nervously optimistic, but that level of nervousness is higher today, or is the highest, I have to say, in the last few years.
Should the Fed just be positively nervous then in that case? Because the argument, the clarion call that's going to go up is they are behind the curve. If it is a soft number, that's what's going to happen, and the swaps market is going to price in a more aggressive cutting trail.
So I think the Fed is, as much as they can, telling us that they're nervous. Here's how I see that. They've been singularly focused on inflation. What we've heard in the last few months, and we heard it again from Chair Powell this week, is that the risks are more balanced. Well, why, if the labor market is so strong, why are other, and inflation is still well known, I mean, we're at 2.6 on PCE, maybe they argue that's close to 2%, but it's still above their target. The unemployment rate is still 4%. Why are the risks balanced? I think the Fed is looking at these cracks that I talked about, that the economy is bifurcated. There are parts of the economy where there is weakness. And the Fed is saying, well, what if this deepens? What if that's enough to offset the strength elsewhere? They're telling us they're nervous. But I think the Fed is somewhat of a cheerleader for the economy. I don't think they can come out and say, what do they know that we don't know? They can't come out and say, we're nervous about the labor market. They're going to let the data speak. Yeah. But I think to your point about rate cuts, that's going to happen. I mean, I think the Fed's telling us, unless inflation really surprises to the upside next week, and we have a big CPI report coming up, they're ready to start to cut. I think they're telling us that they've got two paths. They either cut, soft landing cuts, so they cut to 3.5%, or they cut a lot more. They're telling us that put, even though they never want to say that, but if things get worse, they're going to cut a lot more.
So you think the Fed put is alive and well? And if it is that also a problem? Because essentially what they're saying is we're here to support this market. We're here to support a hot equity market that's also been giving people this wealth effect as we continue to hit new highs.
So I think the put for rates is there. The put for risk assets really depends on the lag. And what we've learned in this cycle is the lags are long and variable. So the Fed can absolutely cut a little fast. Does that really stoke the economy? Now, again, it might stoke risk assets, but it might take a while. If the unemployment rate starts to rise, even if the Fed cuts aggressively, it can continue to rise. It takes a while for these rate cuts to start to feed through into the economy. So I think people may be a little complacent that, if the Fed cuts and the economy is in a recession, that's fine. It may take a while. So I think they may have to be patient. So, and I think on financial conditions, it's context dependent. So I don't think the Fed really looks at financial conditions in absolute. If the economy is weakening, they'll be fine with easing financial conditions because that's what they should do to try and stoke the economy to, a better level.
But we still have seen from things like the Fed minutes, for example, that there are still policy members, committee members who are talking about if inflation does surprise to the upside, they're willing to hike. You hear that from Michelle Bowman. The language is there. So even if Powell does want to cut, and some of the other more dovish policymakers like Mary Daly want to cut, will they be able to, with the presence of still these hawkish members that are still clamoring, we are not there yet and you need to be patient?
I think the way they can finesse that message is to say all we're doing is normalizing. We're not easing. The fact that inflation a year ago, PCE was at 4.5 and now it's 2.5. That's a 200 basis point increase in real rates. So I think the way they can try and square that circle is we're normalizing, we're not easing. Now, if the economy deteriorates fast, I'm pretty sure the hawkish members will also say, well, maybe we should ease a little bit, or let's normalize really fast. So I think they remain data dependent. I don't think you'll hear from them mission accomplished, inflation still north of their target. Political uncertainty, credibility, that's a big question. It's making it, all of this talk around the Fed and political independence is making it, I think, harder for them to cut. But they've been very consistent as long as inflation doesn't resurge here, that they're going to start to cut.
Well, the narrative is, of course, harmonized inflation, has dropped so aggressively that technically, we're in a tight band in rates at the moment. Maybe that's what today's data will tell us. You stick around. Priya Misra from JP Morgan, our guest. We're going to catch up on politics. We've got update stories for the rest of the morning. Here's Bloomberg's Yahara Jaquez.
Hi, Manis. We start in France, where Marine Le Pen is dismissing projections that show her far-right National Rally Party is set to fall well short of an absolute majority in the country's legislative election. Surveys showing the National Rally and its allies are on course to win 190 to 250 of the 577 seats in the National Assembly Sunday. That's well below the 289 that would enable them to push through their agenda. But Le Pen staying defiant, telling a TV channel in France they have serious chances of getting an absolute majority. Meanwhile, in the UK, Rishi Sunak saying he will resign as the leader of the Conservative Party once succession arrangements have been made. This as he steps down as Prime Minister after his party's devastating electoral loss. Speaking just over an hour ago, Sunak said, quote, "I am sorry. The British people have delivered a sobering verdict. I take responsibility for the loss." The outgoing Prime Minister congratulated Keir Starmer on Labour's landslide victory. That's your Bloomberg Brief. Manis?
Dahira, thank you very much. Up next, President Biden's make or break weekend.
I think the race has changed fundamentally since Thursday night. Absolutely. We want to see if he's going to stay in the race before we make any additional call from here. We were telling clients yesterday on a call that we thought there was 3 weeks for the White House or for the Biden-Harris campaign. I think they've got 5 or 6 days to make a decision.
That is up next. We're into the crunch zone on the Biden remaining on the ticket. You're watching Bloomberg Surveillance. Good morning from New York.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
Bitcoin ETFs rubbing elbows with the big dogs.
This frenzy has engulfed the entire world.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, only on Bloomberg.
Jumpstart your trading day with 2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
Bloomberg Open Interest premieres Monday at 9 a.m. Eastern, only on Bloomberg Television.
It is Bloomberg Surveillance. Let's give you a quick snapshot of this market as we are counting down to the non-farm payrolls number. 190,000 is the consensus. We are seeing a whisper number come in a little bit lower than that. You've still got hot stocks, 33 record highs. You've got the euro dollar trading flat at the moment, up 0.1%. And treasuries, all eyes down, yields tick down by 2 basis points. Again, really on politics dominated. Now it is the data. Is it a softer jobs report that takes you to the lower band of 425 and breaks through there post those burst eveners that you have had? Under surveillance this morning, President Biden's make or break weekend.
I think the race has changed fundamentally since Thursday night. Absolutely. We want to see if he's going to stay in the race before we make any additional call from here. I think that if Biden steps aside, they will try to engineer it so that Kamala, the vice president, ultimately locks up the nomination. We were telling clients yesterday on a call that we thought there was 3 weeks for the White House or for the Biden-Harris campaign. I think they've got 5 or 6 days to make a decision.
We're now down to days for a decision to be made. Here's the latest. President Biden is preparing for an interview tonight with ABC. It's going to be his first major appearance since last week's poor debate performance. Now, this comes amid mounting pressure for him to drop out of the race as a new Wall Street Journal poll shows Donald Trump's lead over Biden is growing 48-42. That has widened over the past couple of days. Jordan Fabian is with us for Bloomberg News. Jordan, we've just caught up with Eurasia. They think a 25% probability for Biden to drop out is being generous at this stage. How pivotal will this weekend and this interview be in terms of making that decision for Biden?
I think it's huge. The American people
want to see whether Joe Biden still has what it takes to be commander-in-chief, not just till the end of this year, but for another 4 years. And so far, Biden's reassurances have mostly come behind closed doors. So this interview is a chance for him to speak directly to the public without, notes. This is an interview. He has to speak off the cuff and really reassure people that he's up to the task. So it is huge. And also he has those battleground state stops today in Wisconsin and also on Sunday in Pennsylvania. That's a chance for him to get out in front of those voters who are going to be making that decision in November.
The narrative, the political narrative, is that Kamala Harris, the vice president, is the very obvious person to go to. She can get her hands on the war chest. She is the right person to do this because essentially this is a politically poisoned chalice. And why would any of the other potential suitor names out there want this?
Right. You look at some other names being floated out there, like the governor of California, Gavin Newsom, Illinois Governor J.B. Pritzker, Michigan Governor Gretchen Whitmer. These are all governors with national profiles, people who, people in Democratic circles see as having political talent. The problem is, if you were to pass over, the first Black, female, Asian vice president in favor of those 3 white governors, it could really demoralize a segment of the Democratic base that they need to turn out. And not to mention all the practical questions that you just talked about, access to fundraising, replacing names on the ballot, making sure that delegates are sold on this plan. Those are all easier in the eyes of Democratic insiders going to Kamala Harris than someone outside the administration.
Can't help but wonder, though, Jordan, as a Democratic consultant, Howard Wolfson put it, when you're driving a car off a cliff, there are risks to swerving right or left. If we do get Biden stepping down, is there a risk that this somewhat creates infighting and chaos and feuding within the Democratic Party? In other words, is there damage already done that by simply putting a new candidate at the top of the ticket, that it will not fix it?
Oh, absolutely. Replacing Joe Biden would be a Hail Mary pass at this point for the Democratic Party. You cannot understate the damage that President Biden did to his candidacy with his performance in that Thursday debate. And to your point, replacing not only just a major party presidential nominee, but an incumbent president at this stage in an election is unprecedented in modern U.S. history. It would be incredibly disruptive, even though there are a lot of voices saying the party should rally around Kamala Harris if Joe Biden were to step down. There's going to be a lot of people who say, that's not a good idea, and point to her, flubs in the past, her inability to gain traction as vice president. And so you would have that infighting, and that's not what you want as a political party going in to win an election, especially against somebody like Donald Trump, who Democrats are warning pose a threat to U.S. democracy.
Right, but Donald Trump's big argument has been Joe Biden's age and his, not necessarily his age, because they are close in age, but his cognitive abilities. So if Biden is replaced by someone younger, what does Team Trump do? Because again, this has been their big argument, bringing to voters, saying, look how much more together Donald Trump is than his opponent.
Right, they would certainly have to pivot their strategy. He was caught on this hot mic, sort of disparaging Kamala Harris, and so if she were to be the pick, I would imagine that he's going to dig into whatever personal foibles that person has and put it out there. I mean, look at what he did to Hillary Clinton in 2016. That's the playbook he uses: get down and dirty and personal. But this is the thing that Democrats are grappling with, right? Is that if they were to change out Joe Biden, it would certainly be disruptive, but it would also change the dynamic of the race, introduce some new face, and also remove that question of age from the equation.
Yeah, well, certainly at the moment, it looks as if Trump, relatively speaking, is playing the relatively quiet game, challenging, asking for another challenge, a one-to-one debate. But right now, all they got to do is stand back and watch the Democrats tear one another apart in terms of what happens next internally about the ticket. Jordan, thank you very much. Jordan Fabian there. Our guest this morning is Prime Minister at JP Morgan. She's still with us around this desk for Jobs Report Day. It's very interesting. The equity market, Danny and I have talked about record after record, the bond market. The bond market went from data to politics like that. And it was like steepeners are us. There was such a virulent steepening on the prospect, not just of a Trump in the White House, but a Trump and a Republican sweep. And that invoked the wrath of the sort of the bond vigilantes. My question to you is this: the steepening that you've seen, is there a sense of exhaustion with that, or is there more of that to come as this political race runs forward?
So I do like steepness. I think if the probability of a Republican sweep goes down, there could be some knee-jerk flattening because we've just steepened a lot. But the reason for the steepening, I think, is twofold. The market's pricing in some Fed cuts, absolutely, 50 basis points this year, 75 next year. The end point is still 3.7. I mean, you've heard from President Williams. I think there's a view that the Fed will cut to, even in a soft landing, to 3%. So there is room for that front end to rally. Once the Fed starts to cut, I think we all start focusing on how much are they going to cut. You know, right now there's this probability that they don't cut. So I think as the cutting cycle starts, that front end has room to decline. Now, on the long end, there's the supply question, and I think that should make that term premium move higher. So you can actually see a bit of a twist steepening where the long end can actually stay there or sell off in a Republican sweep. The front end can rally. I think the front end is all about macro fundamentals here. How much is the economy slowing? The long end is more supply. Is this inflationary? The Fed might be in a really tough spot because they want to cut as growth is slowing. But what if, you know, the combination of between immigration, deregulation, fiscal, that there's actually inflation down the road. So as that inflation risk premium rises, I think that curve can steepen. So I think steepeners are the way to trade this market from a risk-reward standpoint.
When it comes to duration, part of the thing that I find fascinating about this is that either candidate is going to be fiscally positive. It's not necessarily like we just realize that all of a sudden after the debate. So if that is the case, as Stephen Major says, is it not already priced in? Is that risk premium of more supply, is it already baked into the picture? Because again, we know regardless of whether it's Trump or Biden or someone else, it's a challenging deficit and challenging growth of deficit going forward.
So that's fair. We've got this unsustainable debt trajectory. But here's where the House and the Senate Congress becomes extremely important. So I think in a Republican sweep or a Democratic sweep, you can still say that both will mean more deficits. What happens in divided government? If you have the Congress different from the White House, trying to get big fiscal policy done or even the extension of the tax cuts, I think all of that comes into question. Markets find it hard to, I mean, these are all binary risks. So I think we're all focused on the White House. We have to look at every House as well as Senate race to try and figure out, is this a sweep or is this still divided government? I think that's the difference for the bond market.
And that is going to come down to the fiscal mandate that's handed. As you say, look, this could all be shredded by Monday. We just don't know who's going to be on this ticket, but it sounds as if the president is going to stick with it. Priya, thank you very much. Priya Misra there of JP Morgan, our guest on the bond markets. Coming up, Pooja Kumar of TD Securities. You're watching Bloomberg Surveillance, live from New York City. A very good morning.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
It is Bloomberg Surveillance. You're looking at a live shot of number 10 Downing Street. The incoming new UK Prime Minister, Keir Starmer, has taken that short ride from Buckingham Palace down along the Mall, back into Downing Street. He arrived, we just saw it a few moments ago, at the rear entrance of the seat of power, which Labour have acceded to with a pretty stunning majority. Danny, I mean, this is Stramageddon. He has a mandate, but as a number of our guests and various people have said, it is a mandate, but it's wide, but it's possibly just a little bit thin. He's got to bring the country with him fiscally, along with policy, in a whole host of ways, because he has got challenges.
Keir Starmer, the thing that Rishi Sunak had said about him was, don't give this man a blank check. Don't give the Labour government a blank check to spend and do whatever they want. It doesn't matter how much of a share that they want. They don't have a blank check. To your point, Manus, first of all, they have a bond market that is very clear in the UK it can give them a check, and no one wants a repeat of Liz Truss. But the other thing, and you've talked about this really well, Manus, the fact that they don't have fiscal wiggle room. Their incoming investments don't look great, weak public infrastructure, and he simply can't throw money at the problem given the deficit. So the kind of growth that we're going to get, that is the question. That's why the Chancellor Rachel Reeves has said this is the most challenging outlay, the most challenging handoff since World War II.
Many people assume that it would take Keir Starmer and this version of the Labour Party 10 years to get back to power. That has happened a lot more quickly and expedited a lot more aggressively, as this was a vote against the Tories, and it was a vote for reform, which is led by Nigel Farage. Again, this was a much contested election around inflation, around taxation, the burden of taxation being so aggressive on the middle class. And these are the contentious issues, the promises of Brexit. This is a party, the Conservative Party, the Tory Party, that took you through that took you into the Brexit referendum. And in many ways, those immigration promises, those fiscal promises, those freedom and growth promises simply have not been delivered.
And it's not just that. If we take a step back and look at what's happening across the world, it is the year of the anti-incumbency. That's what people want to see. They want to see a change. And save for the UK and Mexico, it is a world that is moving more to the right, more protectionist, more isolated, more nearshoring. So I'm going to find this fascinating, the mix of a Labour government that doesn't want to do away with Brexit, but perhaps want to open themselves up to Europe, to more trading powers, but perhaps an increasingly less friendly Europe, especially as we watch things shake out in France. How do those two things play against each other?
Europe have their own very particular form of problems themselves to deal with. They have a lurch to the right, not just in France with Marine Le Pen, but also AfD in Germany. And this is perhaps underreported. There was a demonstrative shift to the right in the United Kingdom. The Reform Party, headed by Nigel Farage, a close confidant of Nigel Farage, certainly in the previous campaigns. Whether that friendship still remains is to be debated. But there has been that, it has been that move by the electorate to Nigel Farage that's demonstrable. Labour took 34% of the total vote, so it is a broad mandate in the House of Commons, but it is supported by quite a small narrative from the populace of the United Kingdom. Pooja Kumra, TD Securities, is our guest this morning. Pooja, good to have you with us. I mean, here we are, we're looking at significant change about to hit the United Kingdom. For the moment, markets, the pound, the gilt markets seem steady on their feet. Will that honeymoon endure?
Oh, when it comes to, I mean, yes, as you said, Labour, right now we are just done with the easy part of the election. It was pretty much expected that Labour will get the win. And I think after a long time, after Brexit, we are basically entering the phase where there'll be much more political stability that we have not seen. So, yes, it's great for the market. But again, as we mentioned, that it's very, Labour is has a lot of challenges to actually meet up to. But on the positive side, they're actually coming in when growth has started to improve in UK, as well as we do expect BOE to actually start cutting rates, which means that generally interest expenditure is also going down. But definitely there's lots for Labour to live up to right now, given the kind of strong win they've seen.
Well, certainly a 60% probability that the Bank of England goes in August. That may well be ahead of the Fed. In terms of the gilt market, this is going to be critically important. The fiscal plan that they laid, they have an autumn statement in the United Kingdom, and then they have a budget later in the first quarter of 2025. You would say that the flow of money, and this is what we've heard from Goldman Sachs, I want to understand from you, the kind of flow from international parts into the gilt market, you think it is supportive, this Labour administration will be supportive to the gilt market with rate cuts. How supportive?
Yes, no, totally. This left is very different from the left we are talking in France right now. So they do not want to actually do the trust thing again. I doubt they are going to change much in terms of their fiscal when we head to the autumn statement. More changes are likely to happen in the March statement. So I think right now Gilt's in a very nice position given the fact that you have so much turmoil when it comes to political uncertainty in France as well as in US as we head towards whether it's Trump versus Biden. So I think from a fiscal perspective, cross-market wise, Gilt's is in a very good place. And we actually like holding Gilt's on a cross-market basis here.
You do make a good point, Pooja. And this is what I was talking to Manus about, that it is not just France. It is election upsets throughout the globe, as it is a world that moves more right and potentially more protectionist and more isolated. What does it mean for the market to grapple with that? Because at the moment, we've been trading this as just idiosyncratic stories between each individual nation. It matters for the peso, it matters for French bonds. But what happens when this global story comes together and globalism, the engine of growth, takes a back seat?
No, that is definitely the scary part, that it impacts growth. It's also inflationary, and I think that is something that those are the effects we're actually going to see going forward. And that especially holds for Europe, because Europe has created this strong integration, and that is definitely at risk as we head towards Sunday elections.
And as we head towards Sunday elections, Pooja, again, this is a market that is treating this like a near miss. The spreads are still wider, but they have come in because you don't have Marine Le Pen's party, the National Rally, securing as much as a majority. Is it the all clear for you as well?
So I mean, we are going to these elections a bit complacent. At this stage, markets are viewing a hung parliament as positive for OATs, just given the fact that no decisions will be being made, just given the fact that there won't be any clear majority. But I do feel that it's not good for France growth as well as deficits. They won't go lower, but I don't see them improving, just given the fact that we are basically, the options right now is either it would be hung parliament with RN as a majority or a hung parliament with a severe breakdown right now, which could also mean we head into a technocratic government, which is definitely negative growth and not positive for France. So even though OATs versus Bund spread, the general levels are pretty much contained, I don't think we are getting back to the 45 level that we saw ahead of the snap elections.
In terms of just stepping back for a moment, Danny framed this, I think, very well earlier on, which is the discontent with the status quo in many democracies, not just the United Kingdom, not just in France and in Germany. There is also a discontent here in the United States of America with the status quo. We're seeing that in the polls at the moment between Biden and Trump. From the global capital flow, and this is what I'm curious to understand, There is this suggestion that with a new form of government and taxation in the United Kingdom and coming potentially in France, that you will see a material dislocation of global wealth flows from the UK and from France. How might that play out on the stage of global investing? Do all roads ultimately then lead back to the United States of America?
I mean, I think there will be there is already a shift of flows happening since the COVID crisis, where all countries were forced to be self-dependent than actually being dependent on others, and that also happened during the Ukraine crisis. So I'm not thinking of a big major shift, but that's the way we are going into. I totally agree with your point, but I think I mean, UK is still a market which is basically owned by non-domestics. I mean, especially when I talk about the fixed income space. As long as we are able to show that kind of stability, I do see a lot of flows coming into UK for sure.
We're just looking at live pictures here as you're talking to us, Pooja. This is Keir Starmer and his wife. They have just arrived now to the front doors of Downing Street. He is walking along, greeting the crowds. You know, this is very reminiscent of 1997 when Tony Blair and Cherry Blair arrived in Downing Street, which is where they broke with that very traditional formal process. They're greeting the guests here. Starmer has a heck of a job in front of him. Sterling is giving him grace and favor. Excuse the pun, of course. Living in number 10 Downing Street, they are grace and favor apartments. The Chancellor lives at number 11. He has a young family. Sterling, up for 7 days in a row, Danny, the longest winning streak in 4 years. Grace and favor for the moment.
It is, but how do they revive growth at a time where the fiscal drag is weighing quite heavily on the UK, where you don't have that investment coming in? Perhaps it is like Pooja and Peter talked about, this idea that you can get inflow because the UK becomes a place of stability. But is that enough? This is a Labour government that has moved towards the centre and cannot spend as they want to because they live with the ghost of Liz Truss.
Well, the ghost of Liz Truss, who has lost her seat.
Yes.
It should also be added. There will be some commentary,
First Prime Minister to do so.
Around that, yeah. The Chancellor of the Exchequer, the former Chancellor of the Exchequer, did indeed hold on to his seat. The fiscal framework, and this is worth just touching on. The promise by Keir Starmer here with his wife greeting the crowds at number 10 Downing Street. The fiscal framework, if he can change the fiscal framework, which is about saying to the gilt market, I want to borrow more. I've been very clear with you, £9 billion or thereabouts, £8-9 billion. But if I'm going to borrow for growth, is it something that the gilt market will absorb easily, rather than perhaps the reckless proposition as it was assumed by Liz Truss?
And I love this, again, from Katie Martin over at the FT, saying that this market knows that there's a difference between borrowing lots of money in a suit and borrowing lots of money in a clown outfit. I'll leave that to you to assume who she's talking about is borrowing in a clown outfit. But the assumption is that this market is trusting that Keir Starmer understands what this means. I was talking to someone from Signum Global last week who said to me, look, they understand that this bond market can push them out of government. France understands that it can push them out of this presidency, and that's exactly why some of the language you hear coming from France as well has been more moderate, has been more tamed, trying to reassure the investor base, because no one wants to be that prime minister. No one wants to be that president that is bullied out by a bond vigilante.
Well, maybe they all went to Italy for a quick chat with Ms. Meloni, in that, again, the panic was that Giorgia Meloni would incite a widening of the spreads. The Prime Minister of the United Kingdom, Keir Starmer, Sir Keir Starmer, is about to address the nation and the world.
Thank you. Good afternoon. I have just returned from Buckingham Palace, where I accepted an invitation from His Majesty the King to form the next government of this great nation. I want to thank the outgoing Prime Minister, Rishi Sunak. His achievement as the first British Asian Prime Minister of our country, the extra effort that will have required, should not be underestimated by anyone. And we pay tribute to that today. And we also recognise the dedication and hard work he brought to his leadership. But now our country has voted decisively for change, for national renewal, and a return of politics to public service. When the gap between the sacrifices made by people and the service they receive from politicians grows this big, it leads to a weariness in the heart of a nation, a draining away of the hope, the spirit, the belief in a better future, that we need to move forward together. Now, this wound, this lack of trust, can only be healed by actions, not words. I know that. But we can make a start today with the simple acknowledgement that public service is a privilege and that your government should treat every single person in this country with respect. If you voted Labour yesterday, we will carry the responsibility of your trust as we rebuild our country. But whether you voted Labour or not, in fact, especially if you did not, I say to you directly, my government will serve you. Politics can be a force for good. We will show that. We've changed the Labour Party, returned it to service, and that is how we will govern. Country first, party second. Yet, if I'm honest, service is merely a precondition of hope, and it is surely clear to everyone that our country needs a bigger reset, a rediscovery of who we are, because no matter how fierce the storms of history, one of the great strengths of this nation has always been our ability to navigate a way to calmer waters. And yet this depends upon politicians, particularly those who stand for stability and moderation, as I do, recognizing when we must change course. For too long now, we've turned a blind eye as millions slid into greater insecurity. Nurses, builders, drivers, carers, people doing the right thing every day, recognized at moments like this before, yet as soon as the cameras stop rolling, their lives are ignored. I want to say very clearly to those people, not this time. Changing a country is not like flicking a switch. The world is now a more volatile place. This will take a while, but have no doubt that the work of change begins immediately. Have no doubt that we will rebuild Britain with wealth created in every community, our NHS back on its feet facing the future, secure borders, safer streets, everyone treated with dignity and respect at work, the opportunity of clean British power, cutting your energy bills for good. And brick by brick, we will rebuild the infrastructure of opportunity, the world-class schools and colleges, the affordable homes that I know are the ingredients of hope for working people, the security that working-class families like mine can build their lives around. Because if I asked you now whether you believe that Britain will be better for your children, I know too many of you would say no. And so my government will fight every day until you believe again. From now on, you have a government unburdened by doctrine, guided only by the determination to serve your interest, to defy, quietly, those who have written our country off. You have given us a clear mandate, and we will use it to deliver change, to restore service and respect to politics, end the era of noisy performance, tread more lightly on your lives, and unite our country. 4 nations standing together again, facing down, as we have so often in our past, the challenges of an insecure world, committed to a calm and patient rebuilding. So, with respect and humility, I invite you all to join this government of service in the mission of national renewal. Our work is urgent, and we begin it today. Thank you very much.
Keir Starmer there and his wife, you can see Victoria standing in the crowds outside number 10 Downing Street. This is tradition. The incoming Prime Minister makes a speech to the nation, sometimes setting the agenda. And very clearly they're talking about 2 of probably the most important agenda issues that Labour campaigned on. The National Health Service in the United Kingdom, making it better, and border control. The Tories had introduced, some would say, a very toxic immigration policy that was tough for the country to chew on. Labour, let's see what they deliver. Danny, he talks about energy bills. He talks about all the issues, really, that he campaigned on. Be calm, be patient. This is about rebuilding Britain.
Brick by brick, we will rebuild the infrastructure of opportunity. And within that same breath, you went on to talk about the importance of rebuilding the infrastructure of schools, of homes. But this comes back to what you and I, Manus, were talking about, of does he have the fiscal headspace to do that type of spending? You could look at their budget and say he does not have the fiscal headspace to do that. And I think that's why you also hear the language of patience. Be patient with us. This will take a while. Rachel Reeves, his Chancellor of the Exchequer, said something similar, that this is the most difficult inheritance since World War II. So they have this path laid out, but they know they can't jump into it, that they have to take their time because, again, they don't have that fiscal room to spend in order to get it done.
Yeah, let's just have a look at some of the UK assets. We have had 2 guests this morning talking about the appeal of UK assets, the island of stability relative to France, relative to the rest of Europe. And this is what you've got. You've got 10-year government bond yields at 4 1/8, ticking down ever so slightly. Cable trades at 127.84. That has been on a run, Danny, up for 7 days in a row into this. Starmageddon has been taken well by the markets, and the FTSE has been making record highs, as we know. It's the longest winning streak on sterling in 4 years. We're in a disinflationary at a full employment world, according to Andrew Bailey at the Bank of England. The US jobs report hits in just under an hour. Sarah Wolf from Morgan Stanley joins us now with her outlook. So we've had a couple of conversations, Sarah, good morning to you, about the jobs report. We're looking for 190. The whisper number is a little bit lower. Are there fissures in the strength of the US job market apparent to you? Good morning.
Good morning, and happy 4th of July week. I think there's 2 things we should be watching that are showing that demand for labor is coming down and supply for labor is waning. And I think both of those factors could be weighing on the labor market report that we get this morning. It's one of the reasons why we have 160,000 on private payrolls. That's a pretty notable slowdown from 230,000 last month. If you look at the supply numbers, immigration flows have been stepping down pretty notably since March. And so that's going to start to feed into weaker leisure and hospitality jobs, weaker construction jobs. And then on the demand side, vacancy rates have been coming down. Initial jobless claims have pretty convincingly been moving higher. And so I think both of those things show us that the labor market, it's still strong, but it's not nearly as tight as it used to be. And you could say that it's in balance right now. And so there's 2-sided risks that we need to watch.
With 2-sided risk, the expectation is for 4% unemployment rate at the moment. Do you think that we're going to go into a period of accelerated unemployment? And if so, at what kind of speed? If it is a low dip number, as you say, at around 160?
We have 4% unemployment rate unchanged, and because you have 2 factors that are weighing on the unemployment rate to the upside and the downside. So if you have a supply-driven slowdown in non-farm payroll, so labor supply is coming down, that actually could push the unemployment rate lower, down to 3.9, even with a weak payroll print. However, if it's demand-driven and labor supply is continuing to rise, that could actually push the unemployment rate higher to 4.1. So there's two-sided risk. We need to be watching the details of the household survey very closely and what happens with the participation rate. More broadly, we are expecting the unemployment rate to get all the way up to 4.2% by the end of this year, which is a bit higher than where the Fed is. We think that's going to be one of the things that pushes the Fed to cut 3 times this year.
Michael Reed over at RBC, Sarah, thinks that it's going to be the supply side. And here's his argument. I want to know what you think about that he thinks the labor market is going to remain tight because of a generational thing, because baby boomers are going to start retiring en masse, and that's why we're going to have a tight labor market. What do you think of that?
That's absolutely true if you look more at the medium and longer term horizon, but we've been having a demographic headwind on the labor force for over 5 years now. One of the things that really is the wild card, though, on how powerful that demographic force is going to be is how much we can increase the working age population through immigration. So for context, right now, the native-born population is only growing by 0.2% on the year, whereas the immigration population lifted overall population growth to over 1.5%. So it's having massive tailwinds offsetting the demographic headwinds. And so that's going to be a huge wild card, especially going into the elections in November and what type of immigration policy we see.
It is a fog for 2025, in the words of Lori Calvasina. Sarah, in that fog, Jan Hatzius over at Goldman had a note out on Wednesday saying that if you take immigration together, along with the tariffs that Trump wants to pursue, that would result in an economic environment where the Fed would have to hike a total of 130 basis points, about 5 hikes. What is your concern? Do you share that concern? 5 hikes from the Fed would be quite remarkable, as we just got a glimmer of a cutting cycle.
We actually take a bit of a different view on the post-election outlook in a Republican sweep scenario, which would result in tighter immigration policy as well as higher tariffs. And it's a little bit complicated because you have weaker growth coming out of a negative supply shock from labor. And then you also have weaker growth because of demand destruction caused by higher tariffs. And then out of that, you can have higher price levels, which tend to come later. They're a little stickier. And so in our view, that negative hit to growth is actually could cause easier Fed policy in 2025 because that inflationary component comes later, more a 2026 story. So we actually have a bit of an opposite take on the 2025 outlook in risk to growth and inflation and Fed policy.
We'll take that contrarian view. It's certainly one to put in the mix. As you say, tariffs could indeed weaken the demand overall. Sarah, we're counting down to that jobs report. We'll see what the number is. We'll see what the unemployment numbers are and the wages as well. Sarah Wolf at Morgan Stanley. So it's interesting, isn't it, that contrarian kind of take on, isn't it?
But again, it's this fog for 2025. Good luck trying to trade this bond market and trade Trump in a day like this, in a year like this.
Let's see what the fiscal landscape looks like. We're counting down to the jobs report. Nadia Lavelle from UBS, Randy Krosner, the Chicago Booth School of Business, Jeff Rosenberg of BlackRock, along with the team from Bloomberg, Ira Jersey, join us to break down the jobs report right here on Bloomberg Surveillance. Good morning from New York.
You look at the number of women that want to learn the game, young girls that are joining on the tee. Really an exciting time for all of us to really capitalize on this moment. When you look at women who are making most of the purchasing decisions in households, whether that's cars or that is home or financial services, and who are going to drive the wealth of the future, it's women.
Obviously, we have our car business and we need to have games here and all that sort of thing, but what else can we do? How do we grow the platform? The whole ticket pricing process. It used to be very yellow sheet of paper, maybe some numbers around it. There was not a lot of science behind it. We're now in the world and have been for many years, as most other similar businesses are, to dynamic pricing. So our pricing for a seat may change hourly if we see demand for that, all driven to maximize revenues.
The balance sheet is so important to the success of the team. And a big part of my role is to make sure that the balance sheet stays strong and that we are prudent stewards of capital. There are things that we can do that are irrespective of winning or losing. Take a look at the first budget that comes from one of the teams and ask questions about Do you really need to spend that much? Are you really shooting high enough when it comes to partnership revenue?
Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry. And
crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
I think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in.
We're
in. Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
What's the key trigger going to be for us to say, okay, that growth is turning into a real growth scare or potentially recession fear? It's the labor market.
What I see from the data is certainly a loosening in the labor market.
I think the risk is that the unemployment may rise a little bit, not a lot, but a little bit from here.
We may be at a kind of inflection point in the labor market where you're actually going to see more weakness on the unemployment rate.
You can have two things be true. We have a good labor market, and it is weakening.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
30 minutes until your jobs report. 190 is the estimate from New York City for audience worldwide. Good morning. This is Bloomberg Surveillance. We're taking over the show today. It's me, Danny Berger, alongside Manus Cranny, John, Lisa, Anne-Marie. A well-deserved break on, for us, what's a busy day. For everyone still out there who decided to come into work after 4th of July, we have jobs data to grapple with, Manus. The question will be is how weak does it look to, one, not only make the Fed cut and lock that in, but to move this bond market?
Yeah, I mean, the bond market has been slapped around, hasn't it? It had political curve steepeners that went ballistic, and then there was the data. Services slowing down to the slowest level in 4 years going into this. So the narrative suddenly shifts for the bond bulls again. They were emboldened, and then they were slapped by the steepener. The question is, Danny, what is it that takes them to 425? Is it an unemployment rate that steadies at 4% and ticks a little bit higher? Incrementally, over the past 2 hours, we've had a number of calls which have gone to the left-hand side of this number, the consensus of 190. We've had a call as low as 160.
Can I just say, you know, in all that political drama, when we're starting to price in the curve steepener, saying what does it mean with Trump, I looked at you and I said, Manus, this is so silly. We don't know what 2025 is going to look like. We don't even know necessarily who the Democratic candidate is going to be. How can you price in Trump now? And we just heard from Sarah Wolf saying that for her, it's going to mean weaker growth. That's what Trump tariffs, that's what the policy is going to translate into. Therefore, you're going to have a Fed that cuts more. Whereas on the other side of things, you have this argument for Jan Hatzius that they're going to have to hike 5 more times. It is a fog for 2025. So how can you trade on anything other than economic data right now? How can you possibly trade the politics?
Maybe this bond market bifurcates itself into 2 sections. The back 6 months of this year, which will be driven by politics, tariffs, inflation, immigration, and then rolling into 2025 with a little bit more clarity around what it is. You may well have a Fed that's already engaged with 2 rate cuts under its belt. What will be the scale of the cutting in this cycle? You go back to the conversation that we had with Adam Posen from the Peterson Institute. He's talking about a mass wholesale removal of immigrants from this country, 1.5 million through to 7.5 million. That gives you super steroided stagflation, and that is not what the Fed wants to do with.
So the estimate for today, 190. Some of the calls vary widely. Goldman Sachs, 140. Citi, 155. JP Morgan, 200. And Morgan Stanley, 210, with Deutsche Bank at 225. Let's show you how the market stacks up heading into it. We've had 33 record highs for this equity market. Can today be a 34th? We're unchanged at this moment. 55.90 is where you stand on your S&P 500 futures. That might be determined by how today's jobs data comes in. Your euro versus the dollar virtually unchanged. Stability perhaps coming through from Europe, the UK, and a French election that showed the national rally with a smaller majority, not even an outright majority. Your US 10-year yield, Manus has been great on this, whipped around first by the politics, now the economic data. Down another, let's call it 3 basis points. 433 is where you stand. NYMEX crude unchanged this morning. Let's get you to your lineup. Coming up, Nadia Lavelle of UBS on why she's expecting mostly modest equity gains going forward. Then we'll be speaking to former Fed Governor Randy Kroesner on why he sees a slowdown coming later this year, and BlackRock's Jeff Rosenberg reacting to today's jobs data. So we begin with that. Our top story today, payrolls are due out in just under 30 minutes. Nadia Lavelle of UBS saying this: economic data is pointing towards a soft landing, which we believe the Fed will get confidence to cut rates later this year. We'll remain constructive on the outlook for equities. We believe the bar is heading higher into the second quarter for earnings season. For the S&P 500, expect more modest gains from here. Nadia joins us now. Nadia, thank you for taking a break from your July 4th holiday to join us today. Okay, tell us. It's one thing to know how the data is going to come in. It's another thing to know how this equity market is going to react. Will bad news be good news for U.S. stocks?
We think so, as long as, it's shown that the economy and the job market is not, falling off a cliff. We know that the job market is the last shoe to drop if there's any significant weakness ahead. So if you can get something, slightly under 200K, I think that will be enough for the market. But I think the general sense is that we remain positive on equities. As noted, we do expect that the second half to be tougher and returns are likely to be more modest from here because the economic data has been surprising more towards the downside. And so that's something that we're continuing to watch. We do see that second quarter economic growth is pointing to below trend growth in line with sort of that Q1. So the normalization process is happening, and the same will happen in equities. What really needs to drive from here is going to be earnings that has to do the heavy lifting, given that valuation are expanded. And so we do think that, growth will continue to work, particularly quality growth. Tech and the AI trade will continue to work from here. For the market to broaden out, we need to see that economic growth kind of accelerate from here and the Fed to cut by the time we get to September.
But what I'm understanding from you, Nadia, is we're not necessarily going to get that. But I could argue that in today's day and age, it doesn't matter. That all that matters is big cap tech and multiple expansion. Maybe you don't even need earnings to show up that strongly, just the promise of future earnings. Can that narrative continue, or will it run out of steam?
You do need earnings to show up. I mean, what's been happening in tech and the AI trend is that earnings has been showing up. That's why these companies are higher. And you see the more economically sensitive areas of the market has lagged because the growth hasn't fully showed up here. Now, is a Fed cut needed for the market to continue to hit new highs? Like, obviously, no. We've seen that this year, as you've noted early in the show, over 33 times new record high, and that's been powered by the AI trade. But in order to have a more sustained rally in the rest of the market, you do need that growth to show up to be able to drive that earnings growth and to see it broaden out, particularly to areas like small cap that are more economically sensitive and the cyclical areas of the market.
So, Nadia, good morning to you. When we look at this top end of the U.S. equity market, the Mag 7, the second half of the year, for me, is going to be about show and tell. It's going to be about delivery of AI, the monetization of AI. How much of that is proven to you? How important is that for you to remain fully committed to the top end and the Mag 7 in the U.S.?
Yes, that's important, but we do think that the market will be patient and give them the benefit of the doubt. We're still in the early stages of the build out of the AI foundation. And so what we've been focused on is really the enabling area of AI. So we'll call that the semiconductors in particular. What's been happening is that you're seeing a massive amount of investment in this space. And so that AI investment cycle is really helping to shift semis from the cyclical industry, as it typically is, to more structural and secular growth. At the same time, you're also seeing a bit of a recovery in the more cyclical end markets in semis. So think about smartphones and PCs. And so this is an industry that could see 35% earnings growth next year on top of that 55% that's expected for this year. I think also, Manis, within tech, even hardware is looking to be okay. You're starting to see like that AI implementation, which again is still in the early innings, but as that build, that could drive a sort of a recovery and upgrade cycle within that areas of the market. So far this year, you've seen software lag because again, that monetization needs to come through, but we think that that's attractive. So what we've been advising clients, because we think that this is a multi-trillion-dollar investment opportunities over the next couple of years, is to really add to the entire value stack. And I think, Manis, or tech overall, including the AI trade, when you think about it, it's like in this environment, high quality, strong balance sheet, strong free cash flow generation, and all of that is helping to, drive, secular growth. And is valuation cheap? No. But we do think that these companies, given the growth expectations and what they've been able to deliver, can grow into their valuation multiples.
I just want to get a sense from you of where you are with the consumer. We know your chief economist, Paul Donovan. We've almost immortalized this phrase, the hedonism of the U.S. consumer. But you talk about the consumer pushing back against margins, getting a little bit more stretched. If unemployment does incrementally rise, not an all-out recession, but drifts higher, consumer will become more squeezed. How do you position for that back-end squeeze?
Yeah, this is one of the reasons why we're less positive on consumer discretionary. As we know, this is an eclectic mix within that sector. So it's not necessarily that we're negative on the consumer, but more on the discretionary goods segments, as we know, remains particularly challenged, particularly the high sort of ticket items that remains challenged. And so the consumer, yes, is pulling back a bit and pushing back on price increases. We're starting to see discounting across the space. I mean, look at the fast food wars that are picking up this summer. But at the same time, the consumer is still cruising, right? They are still traveling. We're seeing, good trends in travel and leisure. So the consumer still has money to spend. They're just being a little bit more selective and looking for value within the broader economy. And that's where I think selectivity is key within consumer discretionary.
We've also just been discussing the right-hand tail risk of multiple Fed rate hikes in the event of more aggressive inflation going into 2025. It's not just one economist that's been saying that to us, but it's multiple people have come on board with this narrative that 2025 could leave the Fed's hands tied. They may have to hike rates. When you and the team stand back and talk about inflation and preparing for a higher inflation regime generally, how do you prepare for that? Is that the commodity exposure? Is that buying tips? In what way do you reflect that hedge?
Yeah, our view is that we do expect inflation to moderate. There is concerns as you go into 2025, depending on the outcome of the election and who wins. We know that former President Trump has been pointing to higher tariffs across the board, and so that has inflationary concern. But in general, we do think that inflation would moderate. But how do you think about positioning for that? One of the areas that we continue to like is more on the commodity side, especially oil in particular. We also like gold here, and we've been advising clients to add to those areas as a hedge against inflation, also in general geopolitical risk. We're not necessarily in the camp of seeing that the Fed will need to raise aggressively in sort of the face of potential inflation risk in 2025. We do think that the Fed will be be on a cutting cycle by the time we get to 25. And a lot of times these things take time to work through the system. Even if in a scenario where we have a red sweep and that ultimately translates to higher tariffs, that is not going to happen overnight. It's more like a 2026, 2027 event, and less so a 2025 event. I think the concern is for 2025 is more a potential slowdown in growth and not necessarily a spike in inflation.
Yep, Sarah Wolf saying the same thing to us, Nadia, that's going to take some time to play out for it actually to be inflationary. Nadia, we appreciate it. Enjoy your weekend. Nadia Lavelle of UBS. Your equity market this morning, basically flat, unchanged on S&P 500 futures. Let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahaira Yaquez. Hi, Yahaira.
Hi, Danny. Gold is headed for back-to-back weekly gains on expectations that the Fed will trim interest rates before year-end. Spot gold traded above $2,363 an ounce. That comes after rising by more than 1% this week. Silver getting a boost from the upswing, advancing back toward $31 an ounce. Meanwhile, in the UK, Rishi Sunak saying he will resign as leader of the Conservative Party once succession arrangements have been made. This after he stepped down as Prime Minister following his party's crushing defeat in elections. Sunak saying, quote, "I am sorry. The British people have delivered a sobering verdict. I take responsibility for the loss." The outgoing Prime Minister congratulated Keir Starmer on Labour's landslide victory. This year's NATO summit begins Tuesday as the alliance marks its 75th birthday. Western leaders will gather in Washington, D.C. as they contend with geopolitical issues, plus major elections. U.S. President Joe Biden is at an inflection point following his disastrous debate performance, while French President Emmanuel Macron will just be emerging after a decisive second round of national voting. And Keir Starmer, whose Labour Party has just swept UK elections, as we mentioned, will have an opportunity to reset Britain's special relationship with the U.S. The summit wraps up Thursday. That's your Bloomberg Brief. Danny?
Yahaira, thanks. A week and a weekend heavy in politics. Up next, counting you down to the June payrolls report, former Fed Governor Randy Kroszner joins us here on Bloomberg Surveillance.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
less than 15 minutes until jobs data hits the tape. Here's how things stack up in the meantime. We're coming off record highs for this equity market. Can it continue? It is slightly weaker for your S&P 500 futures this morning. Euro showing some strength after some stability in Europe after UK elections and another round of French elections to come this weekend. Your 10-year yield down by, let's call it 3 basis points. 432 is where we stand. NYMEX crude little changed at $83 a barrel. Your payrolls report just moments away. The median estimate in our survey calls for 190,000 jobs added in June. Unemployment expected to hold steady at 4%. The lowest call is from Goldman Sachs at 140,000. Former Fed Governor Randy Kroszner joins us now. Randy, what are you going to be focusing on for this payrolls report?
Well, certainly the overall numbers, the unemployment rate, but in particular wage growth, because I think the Fed has made it really clear that until they're confident that inflation is going to be coming down in a sustained and systematic way, they ain't cutting rates. And if wage growth continues to be around 4% or kicks up a little bit, it's going to be really difficult for the Fed to move inflation down to its 2% target.
Randy, good morning. Good to see you. Mary Daly says, we're nearer to the point of where a benign outcome could be less likely. So in her eyes, we're at some kind of an inflection point. Do you think we're at a tipping point? Do you think we're moving beyond benign, where it could become a little bit more malignant?
Well, I think she's exactly right that the way that I think about the Fed's sort of risk management is that they're, I think, much more willing to take the risk that they keep interest rates too high for too long to make sure they bring inflation down, which could mean that there would be a slowdown in the labor market and a slowdown in the overall economy, rather than risk declaring all clear, cutting rates, and then getting back into the difficult situation in the late 70s, early 80s, where they called it too early, and then interest rates had to zoom up to double-digit levels.
Then do you support their prudence? Do you think that they are right to be err on the side of extreme caution rather than, roll the dice?
Well, they certainly shouldn't be rolling the dice. So extreme caution, maybe not, but caution, I think, makes sense. The costs were enormous back in the late 70s, early 80s, the last time inflation had gotten this high, and they don't want to get into that situation again. A lot of uncertainty about whether the economy is going to continue to power on or not. I think there's a reasonable likelihood of a substantial slowdown towards the end of the year. We've finally had interest rates go, real interest rates, that is the inflation-adjusted interest rate, finally go positive, but only about a year ago. With the classic long and variable lags that monetary policy has, we're going to start seeing that probably in the next quarter or so. And obviously, that's why the numbers today are very important.
Well, Randy, someone like Neil Dutta or Mohamed El-Erian would argue that the real caution should be that they need to cut rates, that unemployment rarely moves in a linear fashion, and if they wait too long, and perhaps they already have, that is what indeed we're going to see. So why should the bias be with a high bar to cut rates? Why not go ahead and cut rates if we are starting to see some inkling of a sort of slowdown?
Well, I mean, people have been looking for that inkling of a slowdown for a bit, and so have I. The labor market has continued to be reasonably robust. The overall economy has continued to be reasonably robust here in the U.S. And so I understand their caution. I would be leaning towards looking very carefully to, especially in these numbers and then in the next month's numbers, to think about whether September would be the time for starting to cut. But I don't think the labor market has softened sufficiently to say, it's obviously they should be doing it.
I think it's so fascinating because you can look at so many different things, Randy, and build your own narrative and decide what you want. I mean, America's kind of strange in that we have the burden of just too much data. It is a good thing to some degree, but you can just look at anecdotal evidence coming in. You have two luxury firepowers coming together, merging, Saks Fifth Ave, and at the same time Neiman Marcus, because they're worried about a slowdown in luxury spending. Yet at the same time, you have record numbers of people traveling this weekend who are willing to pay up for that. What becomes your guiding North Star at a time when the data often is in opposition to itself?
No, exactly. And that's why it's easy for pundits to say, it's obvious that they should have done this or should have done that. But exactly what you're saying, the data are not painting a very clear picture. Sometimes they do, but generally it's this sort of very complex mosaic where you're trying to put all the pieces together, and sometimes you build sort of a pretty picture out of it. Sometimes it's a little more like a Picasso, where it's kind of hard to know where the different parts of the image are. So I think that's why I have sympathy for them being cautious, because I think there are very high costs to declaring all clear when they shouldn't. And so as the data become a little bit clearer, hopefully we'll get some clarity here and the numbers in 10 minutes or so, and then they can make some clearer judgments. But right now I can understand why they're going to be hanging tough.
Randy, let's push a little bit more on the lever. You say there is a risk of a substantial slowdown. Randy, it is not 1999, so everybody tells me. Tech is in a different space. It is not, thank goodness, 2008, so everybody tells me. The regional bank crisis was but a mere bagatelle. So the scale of the slowdown, I'm curious to contextualize that, because that is what will define the scale of the cutting in this next cycle. So what does substantial mean?
So I think we'll see the unemployment rate move above 4%. I agree that I think it's hard for the Fed to have this, the Fed doesn't have this exact control. Some people think that, the Fed is so powerful. If they want the unemployment rate to move to 4.2% and stay there, they can make that happen. They have some levers that move in that direction, but to really nail that, there's so many other things that are going on. I mean, think of all the geopolitical risks and all of those shocks. I think those are more likely to be negative than positive over the coming year. I think there's still a broad feeling of uncertainty that's out there with the consumer, so it may not take much for the consumer to pull back.
Okay, Randy, stay with us. We're going to revisit you once we have those job numbers in hand and get your take. Randy Krosner there. Joining us now is Michael McKee, Bloomberg economics and policy correspondent. Mike, because John isn't here, I have to start with this. Is this No Tie Friday?
It's No Tie Friday.
Okay.
John and Mohammed El-Arian and Rick Reeder and the usual gang on Jobs Fridays all agreed that this would be the No Tie Friday.
Okay, give us what signal is this giving, Mike? What are you expecting from the jobs data? What are you looking out for?
Well, I'm looking for a surprise. You go back to what happened last month, and this has happened in a number of different months, and we had 180,000 was the consensus forecast of economists. The whisper number was even worse. People thought we'd get 168,000, and instead we got 272,000. Like, where did that come from, and why did we miss so much? So do we get a surprise like that again this time? The forecast is for 190, pretty much the same as it was last time. The whisper number, 185, looking for a smaller than the economist's number. So what does the actual come out to be? And then, of course, if the unemployment rate should rise a lot, you'd have to go to about 4.4%. Then you get the Somm rule triggered, and then you get a real freak out on Wall Street, I think.
Yep, exactly, Mike. Stay close with us. We're going to go over the jobs number with you. And Manus, it is this curiosity of, if we get a surprise, where does it come from, and what do you care about more? Wages, payrolls themselves, or unemployment?
Well, the Fed seems to be tilting away from inflation. These reports do matter ever so much more now. It is about the scale of slowdown that is going to come. And if it comes in at 190 or less, it's certainly going to be good news for the bond bulls out there.
Yeah, but what do you do if it's hot wages? There are still surprises that might be in the... Good. Well, we're here together to panic on this July 5th after your July 4th holiday. So coming up next, we're going to have that June payrolls report for you. BlackRock's Jeff Rosenberg will be here with us to react. We're going to also revisit Randy Krosner as we debate. Your estimate is 190. The lowest is Goldman at 140. RBC has the highest at 237. Just minutes away on Bloomberg Surveillance.
Or other authorities.
Could face bigger challenges next.
It was going to keep reading World Cup. This is a 3
as the economic picture.
covering the intersections of Hollywood, Silicon Valley, and beyond.
This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
It is seconds until your jobs data. Here's how the market stacks up this morning. Your S&P 500 futures basically unchanged, 0.04% higher. NASDAQ takes the reins as Russell 2000 falls. Let's get a check on your bond market this morning. We are buying bonds ahead of the print, down by 3 basis points for your 2-year yield. 431 is where we stand on your 10-year yield. 449 on your 30-year yield. The data starting to come in now. Mike McKee joins us now. What do we got, Mike?
Well, we've got the drama you were just talking about as you set us up for this. 206,000 jobs created in the month of June. That is much higher than the 190 anticipated. We talked just before the data came out about potential surprises. The unemployment rate is another surprise. It rises to 4.1% from 4%. The forecast was only for 4%, so we've got a difference there. Interesting number for the 2-month net payroll revision. We'll see which months it came out in, but down 111,000. So on the one hand, we get stronger growth in this month, and the 2 prior months, we get a significant drop there. So you put it together, you probably have a slowing economy story. 0.3 for average hourly earnings as forecast, 3.9% on a year-over-year basis. No change in hours worked, 34.3. The labor force participation rate, 62.6, goes up from the prior month, and 7.4% for the U6 number, the underemployment number, as they like to call it. Let me just take a very quick look here at the number of people who were reported hired in the household survey, 116,000 plus. So it's lower than the establishment survey, but we don't have that big gap that we saw last month.
All right, Mike, I'll leave you to look through that a little bit more. Let me show you how these markets are stacking up. It is that unemployment number at 4.1% in the revisions that we appear to be trading on. It is a rally that is thin and it is fragile. We are going back and forth. At one point, it was small caps up precipitously. We're up now just 0.2% for both the NASDAQ and the Russell, having a hard time of what to make of this. In the bond market, the direction is perhaps more clear. It is a bond market where yields are falling over that concern that Mike was talking about, over the concern of economic weakness. If we have unemployment at 4.1%, yields down 6 basis points, more than 6 basis points for your 10-year yield. 4.29 is where we stand. For your U.S. 30-year yields, we're at 4.47, a move of 5.5 basis points. So, Mike, this is a market that's treating this like an economic slowdown. Stocks are unsure of what to make of it. But is that fair, that this is a bond market that looks at unemployment at 4.1% and says, oh no, the Fed needs to cut?
Well, the Fed has a reaction function for this. The markets have an overreaction function for this. The narrative is going to be that this is a sign of a slowing economy. We saw this big revision down in the March and April, or the April and May numbers. April revised down by 57,000. May revised down by 54,000. Very significant numbers. So the overall pace of job creation has slowed, even though this month is higher at 206. there's a good chance it'll be revised down as well. And now unemployment climbing a little bit faster than the Fed expected. They said we would be at 4.1% at the end of the year. We're at 4.1% now. Not triggering the SOM rule, but it does show a slowdown. And then that becomes the question that the Fed has to decide as they try to put together the Picasso that that Randy Krasner was talking about. Is this the slowdown they wanted, or is this a sign that the economy is in trouble? And I think on a slow trading day with not a lot of volume, it's gonna look more like a panic type situation, slowdown. But overall, it just kind of gives you the impression that we are where the Fed sort of expected to be.
Is this going to endorse the Mary Daly view, the Powell view that we heard from him in Sintra in Portugal at the start of the week, which was talking about things are finally balanced now? These kind of revisions, these are not insignificant revisions, 111,000 in both April and in May. So you think this tilts towards that sort of tipping point in the jobs market? Randy Krasner described it as he's expecting a substantial slowdown. Is this the foothills of substantial slowdown?
Well, that's what we have to find out, because you would say that if the number was weaker this month than it is.
Right.
But at 206, that's a kind of a rebound from what happened the two prior months. Now, does that get revised down? Fed's going to have to look at that when we get the July payroll numbers at the beginning of August. They won't have them for the next meeting, which nobody expects them to move anyway. But it is going to be a conundrum for them. I'd say it underlines what Daly and Powell were saying, that they got to keep an eye on this.
And again, I find it really interesting. For the second running month, we have this tension between the headline number and a higher unemployment rate, 4.1%. Again, if you're just joining us now, that's where it came in. For the jobs data itself, 206,000. The estimate was for 190,000. Mike, you're going to stay close with us. Keep digging through those numbers and see what you can see. Joining us now is BlackRock's Jeff Rosenberg, and former Fed Governor Randy Krasner is still with us. Jeff, let me start with you. What's your first take on these figures?
My first take was your first take, that it's the revisions and a little bit the unemployment rate figure that the markets are most focused on here today. Look, I think this is supportive to the story of slowdown in the labor markets that Powell is looking for. I think you see that in the bond market reaction. And I think this keeps September on the table. I think the other story here, and why the market reaction to the revisions, is there's a bigger story that there's more, Manis, that is a beautiful turn of phrase, the foothills of substantial revisions. I think there's a big story there in the market that there are revisions coming, that the establishment's survey is overstated. You do get the benchmark revisions, and there's an expectation here that you're seeing an overstatement, and that is a little bit fed into the market narrative with the 2-month revision number that you highlighted earlier.
Randy, would you agree with that? Some slowness in these numbers, a slowdown potentially confirmed?
I wouldn't say it's confirmed. I mean, obviously, that was something that I'm looking for. I think, as we were describing before, and as Mike picked up on, we've got the different pieces of the Picasso, and it's hard to put the image together right now. And I think this is very much consistent with the Fed's focus and Jay's focus on the labor market, watching it very carefully. This is really consistent. This is broadly consistent with kind of the slow cooling of the labor market that they want. But I think it's going to be difficult to just say, we can stop the cooling whenever we want with just with a couple of rate cuts, because of the long and variable lags. It's going to be hard to do that just at the right time. And so I think, just as Jeff said, the Fed's not going to move at the end of this month. But September is live, because we'll see how the labor market. They'll get a couple more labor market reports before that meeting, and I think that'll be really a key thing. But the wage inflation has not come down. It's basically in the same range that they were expecting it to be. So if that drops significantly, that would give them the okay to go ahead. Now they're going to be cautious.
Is this, Randy, good morning to you. Jeff, good to see you. Randy, is this going to come down to the part of the curve where the jobs are lost? In other words, forgive me for being so brutal, but the quality of jobs that are lost in this next unemployment cycle, that's going to be critically important here, isn't it?
Well, they'll certainly be looking at the types of jobs, because obviously, depending on whether you lose jobs at the higher pay or lower pay, that's going to affect the average wage, the so-called compensation effect. They'll be looking at that. They'll be looking at potential pockets of weakness in certain areas that may be more interest rate sensitive. And so they will be looking not just at the overall numbers, but kind of digging deep into where they see monetary policy having an effect.
Well, when you look deep into those numbers, Jeff, let me bring you back into this, because you mentioned this, a wages growth, 0.3%. There is still growth here. You could even look at the weak ISM services number that we got earlier in the week, and still prices paid are higher. If I wanted to make an argument for why the Fed should hold, I could make an argument about this, that look, wages and prices are still high. It is too soon to move. Is it an error to err on that side, to say, look, we need to continue to hold where things are until some of those factors start to come back in line?
You're pointing out the part of the labor markets that has been the least that has shown the least progress in terms of showing the normalization. So whether it's AHE wages that we're seeing today, ECI, Atlanta Fed Wage Tracker, our own private estimates through scraping jobs posting data, they all point to a similar story, which is the pace of slowdown and the pace of normalization hasn't really kept up. We've kind of normalized to a pre-COVID tight level of labor market conditions and elevated wages relative to productivity. So that's the one thing that kind of keeps the Fed a little bit at worry in terms of moving too quickly. But it's the broader price data we'll get next week that is really going to be more determinant. I think they'll be okay with wages stabilizing, and as long as you're seeing the broader wage pressures continue to normalize, and certainly not a repeat of what we got in the first 3 months of this year of a reacceleration, that's going to be the backdrop for the Fed to open up the door towards slow normalization, maybe quarterly pace of 25 basis point cuts.
Again, for those just joining us this morning, we just moments ago got the jobs figures. 206,000 is where we landed. The estimate was for 190. Also a revision for April and May, down by 111,000. Unemployment rate goes from 4% to 4.1%. Mike McKee is still with us, digging through the numbers. Mike, what's some of the other takeaways you're seeing here?
Well, there's a lot in here that addresses the idea of how serious a slowdown this is, and it might have a bearing on inflation as well. First of all, the unemployment rate, it goes up because we saw a large rise in the labor force, 277,000. Now, what's interesting is that we have seen a decline in immigration. People have been giving immigration a lot of credit for the jobs numbers, and in this case, it didn't translate. The decline didn't translate into fewer people coming into the labor force, but it only pushed up the unemployment rate by a little bit. It was 4.054 when you take it out to 3 digits, so just barely rounding up to 4.1%. And you look at the number of people who lost jobs and got jobs in the household survey, employment and unemployment, they're almost exactly the same, 116,000, 168,000. What really stands out is a very weak performance for service-providing industries and manufacturing. Manufacturing lost 8,000, construction gained 27,000, but for service industries, only 117,000 jobs created, and most of that was in the healthcare field that we normally see adding a lot of jobs. Instead, the big number is government, 70,000. And so the loss of service sector jobs suggests that maybe we'll see some inflation come down in the service industries because labor costs are the biggest issue there. And it also may mean that the government hiring may be a seasonal adjustment problem, and it could end up being revised lower. So at this point, it's definitely, as Randy said, kind of a Picasso here. A lot of different things in here that tell you the economy has slowed, but where we go from here is going to be the interesting question.
I think there's a couple of other numbers that are coming through on the T-Lab that various colleagues are pointing out. Temporary help is down a massive 48,900 in June. That is the most since 2021. And the time that it takes you to get a job, the median time that it takes to get a job has gone to 9.8 weeks. and that's up from 8.9 weeks. Now, look, these are idiosyncratic in those revisions. The powerful message is going to be in the revisions, and it's going to be in the unemployment numbers. But that temporary help, that's quite a flashing amber number, especially given services dropping so significantly to a 4-year low going into this.
Well, temporary help is usually sort of thought of as a sort of canary in the coal mine, because if you're going to be adding workers, you go to temporary workers first. In this case, that doesn't seem to be the case. The interesting counterpoint to that is average weekly hours didn't change, and you would expect that to start to go down if companies were seeing business slow. So that's something to keep an eye on. We did have a pretty good idea about taking longer to get a job because the continuing claims numbers have been going up.
9 weeks of gains,
that's what it's been telling us. But it is interesting to see that maybe this canary just sort of cheaping a little bit here.
Just a slight tweak coming from the canary. Jeff, I want to bring you back into the conversation. BlackRock's Jeff Rosenberg is still with us. Jeff, I want to touch on what Mike was talking about, of particularly the services sector being weak. This is the part of inflation that we had been worried about service inflation not coming back in. If you look at the contours of this report, does it give us more confidence? Is it enough to cement September for the Fed?
Probably not quite enough to cement September. When you look at the services, it's what the conversation was just on. It's that big drop in temp help, minus 49. You know, the 3-month average, it's just a little bit below that. So it is one of the highlights. You know, there's some other industry highlights there. You got a kind of a big offset in government that Mike talked about. So there's some cross currents there. There's a pretty strong construction number that could be seasonal, that could be weather affected. And the seasonals that Mike mentioned are particularly tricky, especially around the government data, given the education flows in and out. So there are some cross currents that make it a little bit tricky, and I think when you're looking at those details, it's hard to say that cements it. I think what will cement September is really, you know, another round of data, and more importantly, what we see in terms of the inflation data next week and what we see next month. I think that's going to be the case. As long as we're seeing trends towards slowdown in top line, the unemployment rate, broader measures of labor markets normalizing, I think that'll be enough. Not enough to say that today, but I think once we get to September, that'll be there. And obviously, as Powell has said, you know, any surprise slowdown, acceleration, you know, the earlier conversation around perhaps there is a bigger revisions and benchmark revision that tells us that establishments as a survey has been much more overstated. Perhaps that comes through. That's, you know, the cement in an environment where inflation is continuing to deliver this kind of pace towards 2% that Powell and the Fed have talked about. A little bit too early to say that that's the read today, but as you can see, and you got up on the screen, you know, the yield reactions are moving towards raising that probability of a move in September.
So, Jeff, tell me this. We had Priya Misra with us a little bit earlier on talking about the reinvigoration, the reincarnation of the Fed, but that is certainly there. When you look at the market reaction function today, yields are lower. Again, the bond bulls have been handed, you know, a fig leaf to reinvigorate their bullishness because they've been slapped by politics in the previous week. Does it embolden you in regards to duration, and does it cause you to be a little bit more anxious about credit?
So I would say on the kind of the Fed put, it is a big deal. And you know, while we're talking about policy, what we haven't really spent a lot of time talking about, and we haven't really heard, what I mean by that is the FOMC and the Fed and Powell, is talking about the impact of financial conditions. And so the proposal, the way in which the Fed has been treating its response function to inflation. If inflation surprises a little bit stronger, they'll hold rates here. If inflation returns to trend, they're excited to cut rates. It's an asymmetric response function, but it's very market friendly, and it's what perhaps Priya and you were talking about earlier, brings back a bit of the Fed put. That's led to much easier financial conditions. And when you look at financial conditions relative to interest rates, what you see is a huge disconnect, that policy is much easier than what the interest rate would otherwise imply. So yes, that's good for risk-taking? Does it embolden duration? I think you got to be careful when you talk about duration in a portfolio about where you hold that duration in terms of maturity. You mentioned earlier this week, we saw a big bear steepening. We've got fiscal policy challenges in the back end. And so I think it emboldens the part of duration that the Fed has its greatest influence over, and that's the front end of the curve, and maybe moving out into the front belly of the curve, kind of the 2 to 5 year part of the curve. But I think the back end of the curve, in that kind of traditional way in which people have thought about using the longest end of duration as its portfolio hedge, I think we have to really rethink that in an environment of substantial changes to fiscal policy.
And that substantial change in fiscal policy, even if it is Biden or another Democrat in the White House, there will still be a continuation of some of the Trump tax cuts. And if it is Trump and a Republican sweep, then the coupon sizes are going to rise. And the theory of the policy that he espouses at the moment is, for some, very inflationary. So is it next year that the bond market is really tested in terms of its appetite to take inventory on?
Yeah, you know, part of it is the pressure between kind of Treasury and the Fed, how much Treasury has been able to hold the coupon issuance back from the bond market by keeping these bills issuance high. And so that time period of when that starts to really be impacted in the back end of the curve, you know, one, it's a function of the expected path of fiscal policy. Two, it's a function of the Treasury issuance pattern. And three, it'll be a function of where the demand falls in terms of global investors, and more importantly, global private investors, because that's the other piece of what is substantially different here, exiting the era of QE into an era of QT. Yes, I know we're normalizing that as well. But there's more reliance on the private markets to fund those increasing debt and deficits. And I think when that starts to hit, and we saw this last year a little bit, is in the quarterly refunding announcements, and when you get that change in that coupon issuance that we know under current trajectories is eventually going to have to happen.
Okay, well, a lot of nervousness going into next year as well, isn't it, in terms of the size there. Jeff Rosenberg with the very latest on his first take on those jobs. Danny gets a short reprieve from Jobs Day Friday. She's going to turn up in the 9 a.m. show. There's no rest for the wicked.
No rest. Before I go, I just want to give a shout out to David Kelly from JP Morgan, just barely off the jobs number. His estimate was for 202,000. I think we should give that a little bit of credence in a jobs data that's increasingly hard to call with each month.
Send him a donut. By all accounts, there's a tray of donuts out there for everybody that survived this jobs report. Without your usual team, but it's from Danny and myself. Danny will appear in the 9 a.m. She's going to take you through that market open in terms of how those equity markets react. Joining me now is Ira Jersey and Michael Casper of Bloomberg Intelligence. Ira, to you first of all, good to see you. The bond market genuflects nicely, 2 revisions, despite the 206,000, 2 revisions coming through in May and April. Yields drop, the bulls are emboldened. Good morning.
Hey, good morning. Yeah, that's exactly what's happened here a little bit. You've had a little bit of a rally in the bond market just on the back of those revisions, and also the slightly higher unemployment rate, I think, is, you know, that's a headline grabbing kind of thing. Although, as Mike McKee mentioned earlier, it was incredibly small. It was all about rounding, quite frankly, to get us to that 4.1. You know, the bond market's thinking that the Fed is going to cut this year. The question is by how much, and importantly, and what I've been focused on and looking at is what's happened for next year. So the market has basically priced in another half a interest rate cut for 2025. So you see things like 2025 Fed funds and SOFR futures. That's where most of the rally, that's where the biggest rally in the market has come from, and that's why you see 2-year notes better by about 7 basis points today.
Okay, let's bring Casper into the conversation. So, a little bit of a revision in the slowdown. I mean, more than a little bit, 111,000 on each. That raises the possibility of another revision to this number when it comes through. But the question is, unemployment rising to 4.1%, the numbers in of themselves, the revision, also a little bit on the shaky ground. Does it cement 50 basis points for 2025?
I don't know if it cements
2024, excuse me.
I don't know if it cements it, but it certainly makes it a little bit more likely. And the way we're watching this for equities is that there's a few ways. First of all, on the unemployment side, that's typically a good indicator of forward earnings growth for the S&P 500. So with unemployment rising a little bit more than estimated, possibly a little slower earnings growth on that side. Just to keep in mind, though, bottoms-up consensus, so the stock consensus is about for 13% EPS growth over the year ahead. If you put that into our model, which does include unemployment rate as one of the factors, that's down to 5.5%. But on the other side is the rate side, which you're talking about. And if it does cement 50 basis points, it does give us a little bit more leeway with the multiple. So in a way, our models are a bit self-correcting in that kind of way.
Okay, Ari, let's just bring it to you. I know that now there'd be a haranguing and a hand-wringing going, the Fed are behind the curve, the Fed are behind the curve. I mean, again, he has always sort of accused the Fed over the past number of months of being behind. Do you think that this emboldens that narrative that they need to be a little bit more forward-thinking as this small slowdown begins?
Oh, I don't think that that's the case at all. In fact, we have a chat with about 1,500 investors in it, and basically everyone's mixed. So, some people are saying that this is a clear sign that there's slowing of the economy and that the Federal Reserve will have to cut earlier, and September seems appropriate. And then some others who are noting that the labor market still seems reasonably tight. Our work suggests that anything above 100,000 in terms of payrolls is actually not a bad number. And if you go back, we're looking at this in a microcosm of the post-COVID era. If you go back to the inter-crisis period, or go back to the early 2000s, or even the 90s, if you have 150 to 200,000 jobs, that's fine. That's good growth, and it's still higher than replacement. So what that means is we would still at 150 to 175,000 jobs created, still be creating enough jobs that the unemployment rate should remain more or less stable. And that would be, that means that the Fed could probably stay on hold a little bit longer.
Ari, thank you very much. Ari Jersey, Michael, last word to you in terms of the equity narrative. As you said, self-balancing models, but the bottom line here is the consumer's going to get a little bit more squeezed again. Is that where the pressure comes in the equity complex? Outperformance at the top in the Mag 7, but you don't go for breadth yet. Briefly.
Well, breadth, we think, is going to increase with the earnings growth picture kind of evening out away from the Mag 7 towards some of the other sectors. You mentioned the consumer, though. Consumer discretionary is at the bottom of some of our sector models. It's a place that we've been seeing some issues with both valuations and earnings. So definitely towards the bottom.
Okay, thank you so much for being with us. That's our own in-house team, Michael Casper and Ira Jersey. Normal surveillance will be resumed on Monday, be assured of that. The jobs report is very clear. 190,000 is what we were expecting. 206 is what was delivered, with significant revisions in the April and the May numbers. Unemployment rises to 4.1%. At 9:15 a.m. Eastern Time, the Open will get together with the Acting Labour Secretary, Julie Su. That is it from Bloomberg Surveillance. I'll hand you across to Danny Berger to take you through the next hour. Good morning.
Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
You are also an owner, I should have pointed out, of 3 major sports teams.
That's right.
And you're the first woman, as I understand it, the first woman to own 3 major, have stake in 3 major sports teams. Is that right?
Yes, and we'll say African American.
You were approached by the owner then of the Washington Wizards and the Washington Caps about maybe buying the Washington Mystics, which is the women's basketball team. And what did you say?
Well, first of all, it was Abe Pollin. He did come to me and Susan O'Malley, and they said, Abe Pollin says, look, I want you to be the face of the Washington Mystics. And I said, what do you mean be the face of? He says, I want you to buy this team. His health was failing. And I have to tell you, and a lot of women can understand this, we never get these opportunities. So that was the first thing that struck me, and I was flattered. I was really flattered. I said, well, Abe, what are the financials on this? And he handed them to me. He says, well, they're not making money. But I was still intrigued about team ownership.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
It's an incredibly fun job, for sure.
We're in the business of leading beyond the numbers.
To me, teamwork is key. You need to identify opportunities and push people.
It's not about how to say no, it's about how to say yes.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
Today's CFO has to be much, much more than a bookkeeper.
I talk more about culture today than I talk about numbers.
It's not just about debits and credits and digits and dollar signs.
It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the Chief Future Officers of some of the world's most influential companies. New episodes this summer, only on Bloomberg. Brought to you by Workday.
From New York City for our viewers worldwide, I'm Danny Berger. Your 4th of July holiday ends abruptly for Jobs Friday. The numbers send the markets for a ride, but we end up right back where we started before the release of the data. Is it holiday trading or was it already priced in? The countdown to the open starts right now. We begin with the big issue, jobs numbers climbing past estimates.
It's the revisions and a little bit the unemployment rate figure that the markets are most focused on here today. Look, I think this is supportive to the story of slowdown in the labor markets that Powell is looking for. I think you see that in the bond market reaction. And I think this keeps September on the table.
Joining us now is Michael McKee, Bloomberg Chief Economics and Policy Correspondent. Mike, you just look at the headline number and you get a sense of strength, that it comes in more than expected. What else is behind those numbers?
A lot's behind those numbers. The 206 that we got was higher than most analysts thought, but it is backed up by a decline of 111,000 jobs in the prior 2 months. So not good news overall in terms of the strength of the economy. Not terrible news, but it does show we're slowing down in the labor markets. We got the same signal from the unemployment rate, which rises to 4.1%, just barely, 4.054 if you take it out to 3 digits, but it rounds up to 4.1. We got average hourly earnings and hours worked as forecast, a slight decline in earnings and no change in hours worked. If we were really falling into a problem with the economy, you'd expect hours worked to go down. Now, last month we had a big question about whether the household survey was correct because it saw 408,000 jobs lost, while 272,000 was the initial print for the month of May. In this case, they're much closer together. We're seeing 117,000 jobs in the household survey, which is at least a positive number. It's not the 206, but much closer to it than we were the prior month, so we probably will not have an argument over that. Where were the jobs? Now, this is really interesting. Service industries, 117,000 jobs. Now, that is a fairly low number given the size of the service industry in the U.S. And look at that temporary help number, down 49,000 jobs. Is that telling us something? Healthcare and social assistance is the usual job provider for the economy and did again this month, but government, 70,000. Now, the question becomes, is there a seasonal adjustment factor there that's at work because of the end of school? that's going to be a question to be sorted out, because if it's just government workers getting hired, it's not going to be necessarily a sustainable good thing. So take a look overall with our ECAN function, which, as I say every week, is something that you can call Danny. She'll get it for you if you need it. If you don't have a Bloomberg, do this. And you can see where the jobs are and aren't. And the top blue on the far right is the government number. And that's the big contributor this month, along with education and health services. And you can see below the zero line, the purple kind of, I don't know, what do you call it, mauve or something like that? I'm not an expert on this, but that's the temporary help services, and they're losing jobs, and that's part of the problem. So you can break it all down on ECAN, and we invite you to do so, and then maybe give us your opinions, because this is one of those where we just don't know exactly what it's going to mean for the Fed, other than we're seeing more money go into the September contracts for Fed funds futures.
I feel the need to just make this clear, Mike. I cannot get anyone a Bloomberg terminal, nor can I give you a discount as much as people would want.
Well, I always tell people to call you late at night. That's the best time.
Well, I'm usually awake late at night getting ready for shows. Mike, thanks so much. Michael McKee breaking down the data for us. Joining us now is Rick Ryder, BlackRock CIO of Global Fixed Income. Rick, thanks so much for joining us. Let me just get your first take on the jobs data.
So thanks for having me today. So the first thing I'd say is it's softer. I mean, the trend continues. The number that I focused on was the same thing that Mike McKee said, 49,000 negative in terms of temporary hiring. That's a pretty good indicator of some softness. By the way, it's the third straight month of negative, so it's not like it was coming back. Secondly, I think professional business services negative. So that's you're starting to see some softening. And then you break down, I think like Mike was saying, if you take 70,000 government, 82,000, that's healthcare and education, not cyclical, not interest rate sensitive. Then you look at the cyclical components, you're not seeing a lot of hiring. So the trend is real. And, I think we're slowing. The pressure on the labor market is definitely coming off. Yeah, consistent what we're seeing on claims, consistent what we're seeing, even though a little bit of a bounce in the job openings and jolts. But you look at ISM surveys. I mean, the economy's softening, but it's you're still 3-month moving average of jobs 177,000. You're slowing by. I think it was 225 or something 6-month moving average. So you're slowing. The trend is real, but boy, it's hard to get worked up to the economy. People, the ones that people like to talk about the hard landing. It doesn't this doesn't tell you anything that economy's hard landing.
And maybe that is why, Rick, you see a bond market that had a reaction to push yields down, but we were basically back before where we were before the data announcement. Same thing with risk assets, same thing with equities. You get a slight reaction and then back to normal. Is it because this is a confusing data with lots of parts to wrap your head around? Or is it because we're all at the beach somewhere, except you and I today?
I think the latter. I think listen, I think, first of all, bond market has a pretty good rally in the last few days. So we're now pricing in fully 2 cuts. Hard to argue you should move a lot more than that. You've had a pretty good move in the 10-year note that, I think we've gotten to a place where you've priced a bunch in already. And, by the way, the same thing with the equity market. We've had a pretty good move. So, this is confirmatory of an economy softening, confirmatory of the fact that the Fed is going to go in September. I mean, I think the odds are quite high that the Fed's going to go 25 in September. Again, it's a lot to come from here to there, but I think you can get another 25 done in December. I think the key point, Andy, that when you go back to, if you think where we are today versus 6 months ago, core PCE running 2.7, real GDP we think is trending 1.5 to 2, employment slowing. The Fed funds rate of 5 and 3 is not the right number. Fed should start getting 25, 50, get 100 basis points ultimately off the Fed funds rate over the next year or so, and then see where you are.
But it is the Fed, Rick, that is talking about cuts with the bar of real deterioration. That when the labor market starts to show some real weakness, that's when they will move. I know that there are pockets of weakness in this report. When you look at revisions, when you look at an unemployment rate at 4.1%. But if it is a high bar, is something like today's numbers enough to confirm Fed cuts? Or do you need to see something that looks like a bigger drop or a bigger move higher in unemployment?
So no, I mean, so I'll say one thing that's really important. We're not talking about a significant easing. All we're talking about is a Fed moving from what is overly restrictive on parts of the economy, meaning if you look at the data, earnings reports, otherwise, credit card delinquencies, lower incomes having some real pressure, small business, real pressure, local banks, real pressure. You've got a Fed funds rate that's 5 3/8, too high. We need to get the funds rate. I mean, even if you got the funds rate to 4.5, not by the end of this year, but if you got it to 4.5 sometime in the middle of next year, you've got core PCE at 2.7. So this is not, gosh, we've got to ease to stimulate the economy. This is just get the funds rate from very restrictive to restrictive, and that is a clear endpoint that you can get to without feeling like, gosh, you're going to create any fuel to the fire.
And as you say, the bond market is priced in large part to that end of this mid-cycle adjustment rather than a classic easing cycle. So where can bonds go from here? Are we just forever stuck in this range if the Fed is on track to do that tweak instead of an actual large cutting cycle?
So, I mean, I've been doing fixed income for a really long time. I mean, one of the beauties of fixed income today is we're going to be in a higher rate environment for a period of time. Your ability to clip coupon and income, and we run a bunch of funds here clipping 6.5 to 7 real income and real yield. And that, quite frankly, I'd love that to stay there for a while. My guess is you're probably going to take 50 to 100 basis points off that over the next 6 months to a year. And anyway, but that's the environment we're in, which is pretty good. I mean, if you're in a world where you'd like to get some income, equities have had quite a good run. I mean, that's a pretty good place. Man, I've called it the golden era of fixed income. I mean, not because rates are going to drop and we're going to be a significant bull market rally, but gosh, to create this sort of yield and have a sense that the central bank's not going to be raising rates anymore. By the way, not just the Fed, the ECB, the Bank of England, other than the Bank of Japan, we're in a global easing cycle. It's just a gradual one. Not bad if you want to create some income.
And it is that Goldilocks that's playing through markets. The tension, Rick, has been from politics. It's going to be a heavy weekend of seeing how Biden performs in an ABC interview with George Stephanopoulos, but it's allowed traders to start to look for Trump, to start to look for a curve steepening that was interrupted by the economic data. So how do you look at these two? Is it too early to start trading in some of the political ramifications for 2025, or will that continue to pressure some of the starting of slowing that is currently rippling through bond markets?
So this is a year that is, I saw a stat the other day that was pretty extraordinary. 80% of the market cap in the world is going to have an election in 2024. 60% of GDP is going to have an election in 2024. So elections are going to drive bond market, equity market. And you think about particularly U.S., you have a dynamic where you're talking about very different tax policy, very different fiscal policy potentially. By the way, you don't know what Congress is going to be. One man's opinion, it's a pretty good opportunity. You get extreme moves on one side when one party takes the lead or performs well or doesn't. And it's been a pretty good environment to take advantage of going the other way because we're still not in October yet, and we're on the doorstep of the election. And by the way, we've had a French election. We just had a UK election. We're going to have, there's emerging market election. I mean, there's a lot going on. I think it's an opportunity to take advantage of it. I don't think rates are going very far. I think equities will continue to grind higher. I think the dynamic around the technicals and fundamentals of equities are pretty darn good. But it's an environment where you get extreme moves on some of these election news, not just U.S., that it's a pretty good opportunity to take advantage and maybe go on the way because markets tend to overreact, particularly in quiet periods. They tend to overreact. And, to tactically fade some of that, particularly when you're in front of the election news, I think is it's a pretty good opportunity.
I was going to say, if you put that trade on with France, which I hope you did, Rick, you really would have paid out on that because you see spreads widen, and then you see election results start to come in saying, okay, maybe Marine Le Pen's far-right party isn't going to get the majority that they want, and spreads come in. They still are wider than they had been before the start of the French election, before Emmanuel Macron called the snap election. So do you want to keep buying French bonds, Rick? Does it normalize, or is that something you maybe don't want to step in front of at this moment?
So, I'll say a couple of things. Russ Brownback, my colleague, who runs a lot of our global portfolios, has been amazing at this. I think you take advantage of it when it moves to extremes. But I think the better, do you want to be in the epicenter of the volatility in France for a variety of reasons? Not sure. Tactically, maybe do a little bit, and we've done a little bit of that. But gosh, the other places like Ireland, Spain, that come under pressure, and there shouldn't really be any contagion. We're not talking about the breakup of the Eurozone. We're talking about a dynamic around what is intra-France. And so to take advantage of the opportunity, both on the debt and the equity side, when you get sort of these extreme moves and people say, my gosh, there's contagion, currency contagion, et cetera, you know, we think playing around the periphery, literally around the periphery of to take advantage of some of that is actually, you know, we think from a convexity, from a risk reward perspective, pretty good.
And all this just also brings us back around to the U.S., doesn't it, Rick? If you look at some other things that are happening around the world and the perceived safety of a U.S. Treasury bond in this very moment. But again, as going back to what we were just talking about, as the political rhetoric ramps up, can U.S. contain those sorts of international flows that are worried about France, that are worried about elsewhere in this world, and come back around to us? Can we continue to be that least clean, the most clean, dirty shirt?
Well, so by the way, the first thing I will say is the reason why we have a dirty shirt or our dirty shirt is the debt in the U.S. is too big. And at some point over the next couple of years, that is going to be something that is going to manifest itself. So I would argue the U.S. is the most resilient, extraordinary economy in the world. It has the ability to take an incredible number of punches. And I always call it the flex economy, because it has the ability to take so much pressure in terms of what happens around the world. There is one dynamic, away from anything significant from the geopolitical side, that I think we got to be careful about, and that is the size of the debt burden. And that is something we're going to watch over the coming years. It doesn't seem like anybody's running for election with the idea, let's get the debt down in the United States. So that is something that is definitely on our radar screen. Away from that, gosh, you know, you can throw a lot at the U.S. And because of technology, energy independence, healthcare development, like the U.S. is pretty darn impressive in terms of its ability to withstand stress.
Rick, we're going to have to leave it there. Thank you so much for joining us, for cutting your holiday short. Rick Reeder of BlackRock there. Okay, let's get a look at some of the stocks that are moving ahead of the opening bell. With that is Jess Minton. Hey, Jess.
Well, Danny, happy Friday here on this holiday shortened weekend. You do have stock futures kind of bouncing around the flat run here, even after that jobs report coming off those session highs, but the S&P 500 and the NASDAQ 100 still higher for the week. But if you want to look at some individual movers here in pre-market trading, not surprisingly, you are seeing crypto-linked stocks moving lower. That is because Bitcoin falling for a fourth consecutive session. You're seeing it trading around 55,300 roughly here. So it's actually at the lowest that it's been trading at since February. And it's also lost roughly a quarter of its value since it hit that record back in March. Obviously, some of the hype coming off of the spot Bitcoin ETFs. Also still regulatory challenges here. Some individual movers, though, you want to see Marathon Digital down almost 7% pre-market trading. You're looking at Riot Platforms down about 5%. And then, of course, Coinbase down about actually more than 5% right now, Danny.
Okay, Jess, thank you very much. Coming up, we're going to go to the White House to get the reaction from this morning's jobs number. 190,000 was the estimate. We're at 206. Julie Su, acting U.S. Labor Secretary, will join us from Washington next. This is Bloomberg.
We invest in, buy, and own the backbone of the global economy. When the water gets delivered to your house, the road you drive on, the pipeline that brings different things to your community, the telecom towers that transmit your phone, the data center, the real estate that you live in. It's what we own and build. So it's really what drives the economy, and you don't often see our name.
Is that a good or a bad thing?
You know, it's just because we're behind the scenes, but it's big with $1 trillion of assets almost. We're behind a lot of the things of the global economy.
So being low-key, do you think it gives you strength?
We just try to be quiet and do our thing, and sometimes it helps and sometimes it doesn't. But I'd say on balance, it's been good for us.
reach, and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Less than an hour ago, we got U.S. jobs data coming in at 206,000. The unemployment rate goes from 4% to 4.1%, with a big revision for the months prior. For the Biden administration's take on the U.S. jobs report, we are joined now by acting U.S. Labor Secretary Julie Su. Julie, let me just get your first take on these numbers.
It's another very solid jobs report. 206,000 jobs created, bringing the total since President Biden came into office to nearly 16 million. I've been here before talking about the unemployment rate. Right? We had an unemployment rate at or below 4% for the longest stretch since Neil Armstrong stepped foot on the moon. And it's ticked up slightly now, partly because we also see an increase in labor force participation rate among prime age workers. People coming into the labor market looking for jobs. It's taking them a little bit longer to find them, but we're seeing a balance between supply and demand when it comes to workers looking for jobs and employers finding what they need. All signs of a strong, steady economy.
The obvious flaw in some of these numbers, Secretary Su, might be the fact that we've had big revisions for the months prior, 111,000. When you look at some of the months prior, do you look at today's data and say, you know, we might expect another revision, that perhaps some of the rosiness of it seems to kind of be undermined with each next month of data that comes in and some of the revisions that come in?
I'm so glad you asked that question, because revisions are part of the numbers that come out. They've always been part of the numbers. It's why we're able to put out numbers every single month and then adjust them to make sure that data that comes in later is incorporated into it. That's why we don't just look at 1 month's data. That's why we look at trends. If you look at by any measure, since 2021, when the president came into office, if you look at the last 3 months trend, no matter how you slice it, the pie is getting bigger. There are more jobs in the economy, more workers are getting these jobs, and the real wages are up, so that means that more working people are also having breathing room to be able to live. Those are all not accidents. Those are all very much fundamental to President Biden's vision of how you build a strong America.
But it is an unemployment rate that did move higher, Julie, 4.1%. And this is what a lot of people have pointed to, that rarely does the labor market move in a linear fashion. The concern is if unemployment is moving higher, then a non-linear move could be what's next on the cards. What gives you the confidence that that strength will continue and you won't see a precipitous move that goes from slightly soft to something more pernicious?
I mean, I guess I'll answer it this way. 4.1% still remains a very, very low unemployment rate. Our economic recovery under President Biden has been the most robust anywhere in the world. And so that 4.1%, it is slightly up from before, but looking at all historic measures, especially looking at recoveries from past economic crises, it is absolutely historic in nature, and that did not happen by accident, right? It was not inevitable. Most people bet against it, but President Biden said if we invest big in America, we can pull ourselves out of the pandemic, prevent economic scarring, and those investments, one reason I'm confident is that those investments are just getting started. The president's Investing in America agenda is putting more money into communities for roads, bridges, clean drinking water, for high-speed, reliable internet. We are tackling our climate crisis. We're putting more wages into workers' pockets. Just this past week, 1 million more workers became eligible for overtime pay because of this president's economic policies. Just this past week, we put in place the first nationwide proposed standard to protect workers from the hazards of heat. All of these are forward-going policies that make me confident that building an economy in which no one gets left behind and workers do well is not only possible, it's the only option for this president.
Julie, I think for this market, there's a lot of uncertainties about 2025. I know there's a lot of drama happening in D.C. this weekend with Team Biden and what happens with that, and the election itself. It's always periods of uncertainty. I'm not going to ask you about that directly because I know that you don't want to talk about it, but when you think about this labor market and what we call the fog of 2025, how do you deal with that and think about that with still the outcomes unknown? And again, as you say, policy still needing to work out. How do you think about that policy when, again, we don't know what 2025 looks like?
No, we don't know. You're right. But I'm happy to talk about it because if we want to talk about the fog, the real fog is, let's look back at 2020. In July, this day in 2020, the unemployment rate was almost 12%. For July 4th, Americans were told to stay home, stay away from people, because we had a pandemic that was out of control with no national strategy to address it. This president has turned that all around. We've been talking month after month about, is the jobs number too high? What is it too hot? Is it going to cool? And each time the answer is that we are moving to a stable, steady economic growth economy, and that is exactly what the president said could be done with the right vision, with the right economic strategy, and the right delivery. So there's no drama here on this side. We know that what we have put in place is working, and we just know that we have to keep at it.
And Julie, I know you've discussed this idea before that, yes, there is strength. However, it is not necessarily an American populace that sees that strength. A lot of these sentiment surveys that we see tend to show a weakening, and they've showed a real substantial weakening in the more recent ones we've got. Some of the explanations have been because of political uncertainty that we were just discussing, of not knowing what things look like. So does the messaging need to change, especially at this very crucial moment where Biden's survival is put into question for this election? Is the current messaging working, you think, on this labor market and the strength of the economy?
I mean, I can say what I see, right? One is, again, I come here to talk about the jobs numbers, and I'm very proud to say, again, none of these numbers, none of these outcomes were inevitable. They required solid leadership and strong economic strategy. We've seen past recoveries. They were not like this, right? The jobs that have been created under this president are more than have been created under any president in the same time period in history. When you look at what he and we inherited, that is, it's really incredible. But I also think this is why I travel the country, right? This is why I've launched Good Job Summer, where I'm going across the country to talk about the need for good jobs in every single community. And what I see there is workers who want to work, Americans with tremendous talent that they want to put to use, and training programs, community college connections, investments that are creating those good jobs. We see them in the jobs numbers, but I see them when I travel and what the real impact is. And I think we see those sentiment surveys starting to turn too, but when I talk to American workers and America's families, they see a president who cares about them, who sees them, who knows that they're not invisible, and is willing to do the hard work to make life better for them.
Secretary Sue, we really appreciate your time this morning. Hopefully you can enjoy a little bit of the July 4th festivities. Acting U.S. Labor Secretary Julie Su there. Okay, let's get you some of your morning calls now. A look at some of the analyst recommendations on Wall Street this morning. First up, Citi downgrading Charter Communications to a sell. The analyst says the company is facing risk to its valuation thanks to a tougher broadband environment. Next, Raymond James downgrading Spirit Airlines to underperform. Analysts citing a lower fuel outlook and weaker fare trends. Finally, China Renaissance is upgrading Tesla to a buy. The analyst citing the EV maker's expansion of its energy storage business and new products from its full self-driving initiatives and robo-taxi units. If you're just joining us, we got payrolls about an hour ago. 206,000 is where it landed, revised down for the prior months by 11 and 10,000. S&P 500 futures, little changed. Coming up, we'll talk about just that with Nancy Tangler, CEO and CIO of Loeffler Tangler Investments, how she's investing in the generative AI surge.
Liquidity is the lifeblood of an airline. We make very conservative decision making about when we raise funding and how we raise funding. We try to diversify our sources, and we're always very focused on the actual rates. And we like to build in flexibility in these financing structures so that we have an opportunity to prepay debt when appropriate, so that we can continue to optimize the overarching rates that we're paying.
What have you learned with the dynamic move of the interest rates that we've seen from Chairman Powell? I mean, do you go fixed structure or floating structure, much more like what they do in Europe?
Yes and yes. We have a mix currently. It's a little bit of a different model than what I was used to in the public company space. Say in some ways we provide ourselves with a natural hedge, leaving some of our debt floating and some fixed.
You have to have the short-term discipline to sort of circle the wagons around cash. I mean, cash is oxygen. I know where every ounce of cash is going, but we also have to be nimble around that as well because things change by the day. I know the folks who aren't willing to invest right now may have large pockets of investment in the future. So I want to be in front of them. They may not be a buyer at this point, but I do want to spend a lot of time in front of that other set that is a buyer at this point. They're interested. They want to be an early adopter of the stock. They're interested in the story.
Watching the countdown to the open. I'm Danny Berger. Moments away, seconds until the start of trading. So we're about to get the opening bell. In the meantime, little changed on this equity market. An interesting reaction to jobs. At first, you get a move higher in equity, saying it looks softer. Maybe bad news is good news. We started to unwind some of that. So little change for S&P. NASDAQ ever so slightly higher. This is the interesting one. Russell 2000 futures goes down nearly 0.4%. Perhaps this was all priced in. That's what Rick Reeder was talking about earlier with us, saying that we already knew that the Fed was likely to cut 2 times. So this only just solidifies this. It doesn't make a big enough difference. Anyway, this is your equity market. Let's see what the cross-asset picture looks like this morning. Your euro versus the dollar, some strength in the euro. Perhaps that has more to do with stability in Europe. A UK election goes as expected. France, it looks like the far-right party is going to get a smaller majority than initially thought. Your U.S. 10-year yield, again, this thing is on a round trip. We're down 6 basis points before the jobs report, down about 4 basis points. Only a slight change. Again, was this just confirming what we already knew? And meanwhile, your NYMEX crude, that is at $83.82 a barrel. Let's take a look under the hood and get some of the stocks that are moving at the start of trading this morning. Joining us now is Bloomberg's Jess Menon. And Jess, I mean, a huge drop in crypto. I know that's one of the ones you're looking at this morning.
Of course. So I have to point out what's happening with Bitcoin because it is on pace for its 4th consecutive session of declines here. So if you look over at this at where it is currently trading around 55,400 roughly there. That's the lowest level since February. Also lost about a quarter of its value since obviously hitting those highs back in March as some of the sort of hype around the Bitcoin spot ETFs and obviously those regulatory hurdles go underway. But a lot of those, if you're looking at some of the individual stocks here, Marathon Digital here down almost 6% now right after the opening bell. Riot Platforms also down close to about 5%. And then you also have Coinbase, of course, down roughly about 6% too.
And Macy's, I know, also on your mind this morning, the will they, won't they of someone finally buying Macy's. Where do we stand now and what's the stock action?
Right, so right now you have the Wall Street Journal actually put out their reporting here. So you have 2 different actually, when you're looking at this, investment groups that are trying to sweeten this type of offer to increase their stake to take Macy's private here. So when you are looking at Macy's stock, actually up about 8% right now, and it's also moving other individual department stores higher too. If you want to look at Kohl's, up about 0.2%, and Nordstrom's also up about 0.4% here. If you look at Macy's, you want to get some size and scope on today's move. Actually, it's best since March 4th, earlier this year when it had jumped close to about 14% 1% here. But of course, when you think about sort of the competitiveness when it comes to the retail landscape, Danny, and especially when you think about Amazon and the issues big box retailers as well as department stores have gone through well over a decade now, this is something that's been ongoing. But Macy's stock, even coming in today, was already down about 11%. We know retailers, especially their margins getting squeezed, especially coming out of the pandemic, that's been a big issue there. But nonetheless, you are seeing some of those department stores moving a bit higher this morning.
And Tesla, we should say, erasing its year-to-date losses.
That's right. So don't sleep on what's happening with Tesla's stock. So to put this in context, if you looked at the first half of the year, Tesla was down about 20% going through the end of June. Now, when you're coming out through the winning streak that it has been on, it's actually just turned positive for the year. Its week-to-date gains is actually roughly around 25%. Of course, we know Dan Ives over at Wedbush, a well-known stock bull who did raise his target on a 12-month basis for this stock earlier this week from, it had previously been 275, it's about 300 now. So that would basically imply around a 20% rise actually from Wednesday's close, since yesterday was obviously a holiday. If you look at the A&R function though for Tesla, 27 buys, 20 holds, and 13 sells right now. But still, that is another stock that obviously was vastly underperforming the broader S&P 500 because of those growth concerns, and now rebounding pretty sharply coming into this new quarter, Dan.
Yeah, although some of those gains are running out. I'm looking at the year-to-date gains, and it went from erasing them to down 1% for the year. Jess, thanks so much. Jess Menton there. Joining us now is Nancy Tangler, CEO and CIO of Loeffler Tangler Investments. Nancy, of course, you and I are going to talk about NVIDIA and tech, but we have to talk about what's been on the docket so far, and it is the jobs data. Sure, the headline comes in higher, but it is an unemployment rate that goes to 4.1%. I just want you to help me make sense of some of this equity market move. You have a stock market that's basically unchanged and small caps that are down 0.5%. I just want to get your take on that.
Yeah, well, I think for me, and Danny, thanks so much for having me. I think for me, the issue has always been the revisions, and they continue to come in pretty hot. And so the market, I think rightly, is not necessarily paying attention to every dot and twiddle like we do, but rather is sort of looking at trend lines. And what we see is that the labor market is softening, and we've been talking about that for 6 months. You could see it in the number of full-time jobs, which declined 275,000 in March year over year. You can see it in average hourly earnings rolling over. And so while the equity market isn't necessarily responding to it, I think we've already started to price in a cut in September and potentially one more before the end of the year. And I can't make any sense of small caps. They rallied heavy last year, and we've been out of them. Like, we have not been one that said in the fall, jump in. We looked dumb for a couple of months, and then they've just done nothing but sell off. And I think part of that is this whole story that the big keep getting bigger and are benefiting actually from higher interest rates, and will also benefit from declining interest rates.
See, this is the thing, Nancy, is you could say, oh, I knew what jobs would come in and I knew all the data, whatever, and you probably still wouldn't have been able to tell me how this market reacted, because it is a confusing one, especially if big cap tech will do well, to your point, in both higher and lower rates, because the philosophy had been higher rates means you have to discount future cash flow and it won't be good. And we've learned the lesson that that's not necessarily true when these giants have big cash stockpiles. So do I just buy tech? Is there anything else I can invest in if the direction of rates is known, but the volatility of it isn't necessarily known?
Well, I mean, there are other things to buy, but let's also remember that the hedgies are all in the Hamptons. So we've got, reduced volume. We've got, a lot of people not paying attention today. And so the market may just sort of drift around until the close, when it may, in fact, rally. But our theme has been old economy companies. We've talked about this, that are focused, that have pivoted to digitization first and foremost, and then it became cloud computing, generative AI, cloud computing. And so there are a lot of names in our portfolio that have actually exceeded the performance of the S&P that are not in technology. So think Goldman Sachs and American Express, think Quanta Services, Raytheon Technologies. These are all companies, Chipotle, that have, embraced digitization and or automation, robotics, and that has benefited their overall performance. Walmart, Tesla, those are names that we talked about in April around earnings, and you reported on Tesla. That's been a great holding, at least for the last 3 months.
Nancy, thank you for reminding us that there are other stocks out there besides NVIDIA. I'm going to be honest, sometimes I forget when I wake up in the morning and check what NVIDIA is doing. I found it really interesting, too, that Piper Sandler on Wednesday dropped their coverage of the S&P 500, saying that they were no longer going to give price targets because it's no longer instructive for their investors. They called it an exercise in futility to call the S&P 500 the market, because at this point it sometimes feels like it doesn't properly reflect what's happening under the surface. I just want to get your take on that. I mean, every day when we're talking about the S&P 500, if it continues what it's doing now, going to be another 34th record high for this market. Are we missing the point by just talking about the headline index at this moment?
Well, I mean, yeah, it's just like talking about the Dow to some extent. You know, that's sort of an old memory for many of us that started in the business in the 80s. But I also think dropping coverage could be a little bit about job security, because we've seen a couple of strategists who've been wrong, who've been epically wrong. And that's the risk when you're trying to, estimate. I mean, I wish the Fed would do a little bit more estimating and looking forward, but you do have to take a look at a whole host of things just besides price targets. And if you look at the concentration in the S&P, look at it compared to other developed markets. We're much less concentrated than the DAX and the CAC and the FTSE, but also negative breadth is characteristic of a bull market environment. And I've drawn the analogy to the 90s for the last year when I was actually managing money. This is also what we saw then. We saw periods of very concentrated movement, and stocks continued to do just fine for a long time. So I think everyone should take a breath on some of this and look, as we have, to other aspects and other sectors of the economy.
Nancy, you are one of the best. We love having you on. Nancy Tangler of Loeffler Tangler Investments. Thanks so much. And by the way, Nancy obviously couldn't name names, but I will go ahead and do it. Marko Kolanovic leaving JP Morgan. We learned that in the middle of the week. Not necessarily saying it was because of this, but he has had a string of wrong market calls. Okay, coming up on the show, a labor victory.
From now on, you have a government unburdened by doctrine, guided only by the determination to serve your interest, to defy, quietly, those who have written our country off.
We're going to discuss election risks around the world up next on Bloomberg.
The names that move markets are on Bloomberg.
You know, with all due respect and thoughts and empathy and sympathy for the people who are suffering at the moment, and there are plenty. It's not just Ukraine and Gaza, it's in many other corners of the world as well. But I'm constantly surprised by the level of resilience and the capacity to actually bounce back from those traumas. So I have faith in the human beings and their capacity to respond to adversity. We've seen it. You know, look, earlier in the pandemics, we thought that the world was coming to an end, right? It hasn't. Nobody thought that vaccines would come up in such a short period of time. And every time we have to constantly resurrect this spirit of resilience.
But are you hopeful that
I'm always hopeful. Oh, come on, we have to be. We have to be.
Bloomberg. Context changes everything.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
From now on, you have a government unburdened by doctrine, guided only by the determination to serve your interest, to defy, quietly, those who have written our country off.
I am sorry. I have given this job my all. But you have sent a clear signal that the government of the United Kingdom must change, and yours is the only judgment that matters. I have heard your anger, your disappointment, and I take responsibility for this loss.
The Labour Party winning a landslide victory in the UK election, dramatically reshaping the political landscape. Let's get over to London, where Bloomberg's Anna Edwards is standing by. Anna, what sort of mandate does Labour now have to lead after this election?
Hi, Danny. Yes, well, on paper, a very big mandate. You know, as you say, a landslide victory for the Labour Party, not quite as good as Tony Blair in 1997, but not a million miles away. And so that does give a big mandate, and with that comes a lot of responsibility, as we heard Keir Starmer saying, echoing Tony Blair a little bit earlier on this morning. There are some cracks in that, though, in that because of the way that the UK system works, they secured this even on quite low turnout. Their vote share didn't really increase all that much from 2019. So they didn't necessarily win all the arguments, but certainly their rivals were struggling. The Conservative Party, certainly the SNP in Scotland, all of them struggling, and that's the way the UK system works. As a result, they get this big landslide, and now they have, as you say, their hands on the levers of power. And so 14 years of Conservative Party rule is brought to an end. All of the chaos and turmoil that went along with that, and we remember, of course, the Brexit referendum in 2016. That was a big distraction for everything UK political for a very long time. And then into the pandemic and the inflation push that we saw, and that was very much a global story as well as a UK one. But that led to a lot of infighting within the Conservative Party. And so now we turn the page to something else. Keir Starmer trying to sell a message of hope, trying to sell a message of thinking about the future today. You heard a few of his words there. He's trying to say, you've lost trust. We're trying to build belief in the future. That hard work starts today. He wants to be a government of stability and moderation. And Danny, he talked about public service time and time again on the campaign trail, and he was doing it again today. A real sense that the tone of UK politics will change. He'll get a chance to demonstrate that in the weeks ahead. He'll be at that NATO gathering stateside in less than a week, in fact, and then he'll be meeting with EU leaders later on this month, a chance to reset the UK's relationship on the global stage, at least from a tone perspective for now. Danny.
Hey, Anna, appreciate it. I know it's been a busy week for you, so go enjoy your weekend. Anna Edwards in London. Now, in the meantime, France is now getting ready to head to the polls this weekend. No rest there. The director of Institut Montaigne had this to say on what lies ahead.
As you know, it is absolutely critical that this budget law is passed for the continuum of state. So the main trial will be in the fall. That will be the moment of truth of the new government, whichever it is.
Let's get more context on the French election with Bloomberg's Caroline Conan, who joins us now from the Aix-en-Provence Economic Conference. Caroline, what is the mood among executives there? It is a market that has calmed down. Is there more confidence among those on the ground?
Danny, I've been covering this conference in Aix-en-Provence for more than a decade, and I can tell you it's a very, very different mood than usual. Usually, it's the beginning of summer, you hear the cicadas, everybody is in a positive attitude, but with these snap elections, with this runoff on Sunday, there is a lot of anxiety among the executives here in Aix-en-Provence. And for the first time in more than a decade, there is absolutely no politician here. None of the ministers from Macron's government have made it here because most of them will actually lose their job in just a couple of days from now. So there is no need to despair, according to the Institut Montaigne director that we heard earlier, but there is not much sign for optimism either, because the two scenarios that we have at the moment, which is either an outright majority for the far right or a hung parliament scenario, are a little stressful still for the markets, a little stressful still for the executives, because that adds a lot of uncertainty for the tourism sector, the construction sector, the energy sector. I was talking, for example, to the neo-CEO specialist of renewables just a few minutes ago. He was telling me there is a lot of wait-and-see attitude because we don't exactly know whether that means a less focus on climate change and perhaps less money for the transition, for the climate transition, less money for renewables. I was also talking to the head of a consulting firm called SIA Partners, who's based in New York now, and he was telling me the view from abroad. Remember, a month ago or 2 months ago, we were at this Choose France Summit where Macron was inviting 100 CEOs to tell them about the greatness of France, the attractiveness of France. And now everyone is asking, why France? Why would we come to France? Why would we come to invest in France, given we're going to have this uncertainty for another few weeks? So a lot of anxiety, wait-and-see attitude, even though some of the polls are showing that an outright majority for the far right is not unlikely.
Caroline, appreciate it. Caroline Conan in France there. Now to do a trip around the world, let's head back to the U.S., where President Biden is headed into a make-or-break weekend for his campaign. He'll be sitting down for a primetime interview with ABC News as calls for him to drop out persist. Joining us now is Bloomberg's Joe Matthew in Washington. Joe, not only are we going to have this airing tonight, but we're also going to get an unedited version, a transcript of how the interview goes down. So what is the Biden team hoping to accomplish? Is this enough to restore some of the confidence that was lost after the debate?
Not likely. I mean, even Democrats say we're going to need more than a single interview, Danny, but this is the start here, and it's going to be an important one. It's unclear how much time Joe Biden will give in this interview, and I think there's a hope that it's more than 10 or 15 minutes to see him walk through the paces here. But this is just the beginning of what's going to be a test that could last the better part of a week here, the way his schedule is looking. He's on to Wisconsin today for a rally that will likely include a teleprompter, be going to Philadelphia over the weekend, and we've got our NATO summit here next week in Washington. That's a big deal. He's going to be hosting a solo news conference with reporters that could last an extended period of time at the end of the summit, and that could be an even bigger test than this interview today. But I'll point you to something else next week, and that's the return of House lawmakers here in Washington, D.C., and they've all been asked about this in various media interviews. They've been on the phone together, and we now have a third lawmaker. I just want to point you to the evolution that we're seeing here with some Democrats. Congressman Seth Moulton, a Democrat from Massachusetts, has now become the third House Democrat to call for Joe Biden to step down. He said so in a radio interview on the 4th of July in Boston, saying that the president should follow in one of our founding father, this is a quote, George Washington's footsteps, and step aside and let new leaders rise up and run against Donald Trump. That's a quote. We talked to Seth Moulton on Tuesday here on Bloomberg TV. This is what he said to us when I asked him directly if Joe Biden should step down.
There's certainly a view that the chaos that would follow would be worse than just having a nominee that we know and that can trust. And then, of course, there's the other view that the debate was a disaster and we just need to move on. I'm not sure exactly what the right answer is yet here, but I can tell you we are having those serious conversations as any serious party should.
Fast forward 2 days, those serious conversations lead Seth Moulton, a Biden ally, to call for him to step down. So that's what we're hearing, and conversations like the one that the president will have today in this interview are going to go a long way to lawmakers deciding how they feel about this in the week ahead.
It's interesting, this strategy, as you say, Joe, that this is just the first step, but get Biden out there, have him do M&As, have him talk to people in order to really get that confidence, again, that this is not a cognitive decline, that it is a one-off. But in the meantime, Joe, what's the horse trading happening in the background? If we are starting to think about someone else besides Biden, is that conversation still alive and well?
Well, it's a really important question, and I'm not sure anyone has a real answer because these are quiet conversations being had, and I'll tell you, they, in the last couple of days, have pointed us back to Kamala Harris. You know, even the night of the debate, we were hearing about Gretchen Whitmer and Gavin Newsom and starting from scratch here, but there's a vice president. And when you look at some of the polling data, Siena and The Wall Street Journal both showed Joe Biden down by 6 points against Donald Trump. A CNN poll just out found Harris in a statistical tie with Donald Trump, and in fact stronger than Joe Biden when it comes to two important groups, women and independents. Kamala Harris has seen her favorabilities rise in our own Bloomberg swing state polling since she's taken on the mantle of a spokesperson, the face of the issue of abortion. So imagine a world in which Kamala Harris is tied up with, say, a popular Democratic governor, a Roy Cooper, maybe Governor Shapiro. There are a lot of different ideas about this right now and could have a very interesting story to tell for Democrats, as opposed to throwing all of these pieces up in the air and starting from scratch in some sort of mini primary. A contested convention in Chicago in August could be very disruptive for Democrats, as Donald Trump learns now again his sentencing has been delayed, and he's going to soon be naming a vice president, making a lot of news in Milwaukee just a week away.
Yes, let us not forget that, Joe. A busy month, a couple months ahead on the road to November 5th. Bloomberg Balance of Power co-anchor Joe Matthew there. Now, coming up, the market-moving events that you need to be watching as we wrap up the week. That's next in our Trading Diary on Bloomberg.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
For your Trading Diary, what you need to be watching today and next week. President Biden will be giving an interview on ABC tonight. Powell is set to testify on Capitol Hill Tuesday and Wednesday. And then on Thursday, we're going to get CPI data, and Friday, big bank earnings kickoff. JP Morgan, Wells Fargo, and Citi start the earnings season. In the meantime, it is still a reaction to jobs data. Or is it? Are we all just at the beach and thin liquidity and these moves you can't trust? We did have jobs data. Headline comes in higher, but so does unemployment. So does revisions for the month prior. Russell 2000 down 0.5%. Your NASDAQ up 0.5%. It is still a tech-led market. Meanwhile, the S&P 500, 5,544 is where we trade up 0.1%. This was the countdown to the open. And beginning on Monday, tune in to Bloomberg Open Interest. That'll take place from 9 to 11 a.m. Eastern.
decided to acquire Indeed 12 years ago when I was 36. I couldn't speak English, but I decided to move to the US with my family. Okay, let's study English. Let's, manage this big, American company. But I couldn't do it. Ages are just numbers. If you stay being very curious to run new things, you can keep doing that. So what we're trying to adjust is our company should be the place to maximize people's ability, people's talent, and people's passion, right? Our employees' passion. So we believe that if we can have the work or the vision, people can be passionate, and which is aligned with all what employee wants to do, that's the best way to maximize the people's ability.
Follow your passion.
That's right.
So whether you're 14 or 40 years old.
I think so. Because, what's the difference? I don't know. We might be totally wrong. That's how we have been running this company for 60 years.
Good morning from our world headquarters in New York. I'm Manus Krennic.
And I'm Danny Berger. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday at 5 a.m. Eastern. Bloomberg. Context changes everything.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Good Friday morning from the Bloomberg Interactive Brokers radio studio and simulcasting on Bloomberg Television. And I think we're also doing that YouTube internet thing. So head over to youtube.com and you can search Bloomberg Podcast. And that's where you'll find all of us here. We have a special couple hours coming up here. Alex Steele's off today, but we have Caroline Hyde joining us here, as well as Danny Berger later. We're going to bring you the market moving news here. We've had that jobs report today. Came in headline a little bit better than expected. All good news there, but we had some negative revisions, so we've got to keep an eye on that. Looking at the markets here, not a whole lot of movement. We got the S&P up about 0.2%. The Dow's kind of flat. The Nasdaq's up about 0.5% here. I think the action's a little bit in the yield space here. We got the 10-year Treasury off about 4 or 5 basis points, 4.31% here. So I thought it was going to be a nice sleepy Friday, Caroline, but we've got some news from your homeland. We've also got some economic news here, so a lot to parse through this morning.
I mean, this beautiful macro picture of economics meets politics.
Yes.
And politics wherever you look, whether it be here in the United States, over in my old town of the United Kingdom. British pound up 0.3%. Look, it went the direction that many people felt. A landslide towards the Labour Party, a real viewpoint that now they can govern and govern decisively. The question is they've left a lot of things open as to the direction of travel for the UK going forward. But the market likes it. The pound up, and indeed the FTSE's been up, and some of those ETFs that track the UK here in the US also trading higher.
Can we expect the UK to try to get closer to the EU? And if so, will the EU welcome them back to some degree?
Interesting. Well, that trade deal that was negotiated by Boris Johnson, the former Prime Minister, is up for renegotiation in the next 18 months. The new head of, the foreign relations over in the United Kingdom, whoever that might be, the view is it's going to be David Lammy, will have to be renegotiating that. They want to make policy easier when it comes to animals, when it comes to the understanding of people's qualifications, the ability to travel, move abroad.
All right, let me ask the dumb question of the day. You're flying from London. Let's say you're going over to Switzerland. Do you have to do passport stuff?
Yes.
Oh.
Man.
And you still voted for that as a country.
Not
I mean, for no other reason I would vote against it.
I mean, well, this is where the generational divide comes, right? And I think that's the difference between, and I'm not here to pass politics, but Brexit really divided generationally, not just between area from area. And it's mainly because the youth were like, really? I can't travel and work in Europe anymore? That's a bummer.
Exactly. All right, good stuff there. So we're looking at these markets. So what are you looking at, Caroline? Anything particular in these markets?
Well, I mean, I kept a close eye on the pound. I think you've got to keep a close eye on what's happening with the euro as well. And indeed, look, this isn't the only political risk that we've had. We've got the drama to come on Sunday over in France.
Yes.
Euro, little changed at the moment versus the US dollar, but actually, we've seen that call from Morgan Stanley yesterday saying buy French stocks ahead of this election because we're likely to see actually the worst case scenarios for the markets at least not come to bear. Yes, there's going to be some sort of stasis in terms of ultimate policy making in France and a messy coalition likely, but they do feel that it's all been priced in.
All right, very good, Caroline. We had that unemployment data came. We had the non-farm payrolls came in at 206,000. So it looks pretty decent, but we had some revisions. I think we're supposed to pay attention to those revisions. I know Michael McKee does. Michael McKee covers all the economic stuff for Bloomberg. Michael, what did you see here today?
Revisions, sort of like a dead fish being slapped in the head, getting slapped in the head with a dead fish because it took the joy out of 206,000. We got 206,000 jobs added, which normally would be good, but the prior 2 months revised down by that significant amount. It sort of leaves us with the narrative that the economy is slowing. We don't know how fast, but it's definitely going down. The revisions show a weaker underlying labor market. That's the ultimate story about all this. Unemployment did go up to 4.1%, but it was barely up over 4% because it was 4.054. So rounding it.
Did we do that?
It wasn't huge. Well, I'm sorry. It is No Math Friday, I guess. Yep. Big gains for healthcare and government, which are not rate sensitive. That's the thing. But service industries only gained 117,000. So it does appear maybe the Fed is slowing demand. Companies are slowing their hiring process. And if all that's the case, then we're likely to see continued progress towards a September rate cut. Although the interesting thing is you look at the markets this morning, and they have barely changed the odds of a September rate cut. It's about 0.78% of a full one rate cut, and that's about where we were on Wednesday.
The markets may be factoring in more than some of the swaps market. Carol Pepper, get an investor take with the CEO of Pepper International, family office located here in New York City, but you got more than 25 years, not to age you, Carol, but more than 25 years experience in wealth management and family office focus. Carol, was this a kind of Goldilocks moment when it came to the jobs data? Michael McKee really highlighting there, look, from a swaps perspective, look, the market isn't any changed on whether or not we get that September hike, as in it seems to have been well balanced and priced in before the jobs data today.
Yeah, I think it was a good number, and I think that revisions are helpful. It, again, continues to build the case for the rate cut. So for traders, they're going to love it. I think many of them are out in the Hamptons this weekend, and so they're just not weighing in, but we'll probably see more action on Monday as they absorb all the new data. But I would say it's a good number. We are in sort of a Goldilocks moment. We are looking very good to the rest of the world as an investment haven. As you know, I manage money for families with over $100 million globally, and the foreign families love coming over here. This is the market of choice for many non-U.S. investors because on a comparable basis, the U.S. stock market is very attractive relative to their other choices, even with the strong dollar.
So where do we go then from here? I mean, this data you saw here today, does that change your view of kind of maybe where you should be allocating assets when you talk to your clients?
No, I mean, my clients, we allocate assets on a long-term multi-general basis. So, no, I think, we've always favored growth over value. We've always favored having a large cash cushion to make sure that if there are bumps in the road, you're protected. Sort of a barbell strategy. And that has worked very well for the clients. I don't think anything we're seeing really negates that strategy overall. If you're an investor versus a trader, you're looking for long-term returns. You're looking for the big trends. And how do you play those over multiple years? We're not day trading their portfolios.
How about alternative investments? I hear that more and more from more and more types of investors. Even, you talk to RIAs who are managing money for individuals. They talk about alternative investments much more than I've heard in the last maybe 5 to 10 years.
Yeah, well, alternative investments are viewed as the way to really get alpha these days. All market investments, whether it's portfolios or individual stocks, you're essentially getting the market. Unless you are smart and pick a few of the big market leaders in tech, then you're going to get an outperformance. But alternative assets are somewhere between 30 and 40% of family office portfolios. So it's a big number, and that's true globally. That's from a UBS study that's done every year over thousands of global family offices of all sizes. So yes, alternatives are exciting, and RIAs are starting to get into that because the big sponsors like BlackRock or Goldman to offer them in smaller chunks to the RIAs so that wealthy individuals as well as family offices can invest in these things.
I really like the point you made about international money flows and then coming into the United States. The US has been the game in town largely because of the magnificent 7 that became 5. Maybe Tesla breaking back into positive territory today on the year means we're back to potentially 5.5. But I'm interested from your perspective whether that AI run, whether that no matter which direction of travel that jobs go, we still go up, is still in place?
Yes, I think so, because again, there's so many industries that are just starting to think seriously about how to include AI in their strategy. Look at utility companies. There's tremendous additional efficiency we can get out of our power grids if we use AI on all the utilities, but not everybody has bought all their equipment yet. So there will continue to be a shortage. And until a really strong alternative to NVIDIA shows up, that is still going to be the best way to play the AI trend. If you look at some of the AI ETFs, they just aren't making the cut because really it's a one stock story right now. Same with Ozempic or some of these other, trends that are very big. There's 1 or 2 leaders and everybody else is trailing behind the big fish. So if you're going to get into that trend, you might as well just buy it directly, stick it in a trust or in a retirement account or a kid's college account and forget about it. And therefore, when it's time for your kids to go to college or for you to retire, the money's there waiting for you. So market leaders will continue to dominate. Growth will continue to dominate, my opinion, and so will tech. This market is kind of more of the same, but again, even more, with some of the things going on in Europe right now, the war dragging on, is still attractive, very attractive to non-U.S. investors.
What about investment, though, in emerging markets? We have seen that AI trade benefit SK Hynix, Samsung, numbers from Samsung looking really good today. Are you looking at Asia, maybe not at China, but everywhere else in emerging markets more broadly?
Yes, definitely. I think there's always a place for diversification. You can't just buy 3 stocks if you have a huge portfolio. Obviously, the institutional model still works. You want to spread your risk over a number of asset classes. And Asia ex China is doing extremely well. It's ironic. We used to always say Asia ex Japan, but Japan is coming back. And now China, unfortunately, is the country that we kind of have to avoid because of some of the sanctions. So there are emerging market ETFs now that have come out, which are Asia ex China. And they're doing quite well. That's a good way to play it, like EMXXX. That's one we can look at. I also like the nearshoring trend in Mexico. That's a little harder to play in the public markets, but I would say that many family offices are doing direct real estate deals across the border because a lot of the nearshoring manufacturing facilities, warehouses, et cetera, are relocating to Mexico rather than shipping goods in containers from Asia. So that trend is going to accelerate, and Mexico is exploding. Even with the left wing, let's say, I don't think that Claudia is going to do anything to wreck the golden goose of this in business in the United States to stay in power. So I do think that that trend is going to continue and accelerate. So Mexico is great to look at. Asia ex China is great to look at. Quite far abroad, often partnering with other families from those countries to do direct investments.
Hey, Carol, thank you so much for joining us. Really appreciate it. Carol Pepper, Pepper International CEO, giving us her thoughts on these markets. Stay long. Big tech, how about that? Right now, let's get a market update. Let's bring in our good friend Jess Medin. She covers all the markets for Bloomberg. Jess, what are you looking at here?
Well, when it comes to individual movers, I feel like since Tom Keene has exited the radio studio, I am allowed to bring up Bitcoin now. So if you're looking at where it is trading around 55,500 roughly here. So it's on pace for its 4th consecutive day of losses. It's also dropped around a quarter of its value that it's lost since since its March record there, just because of obviously the hype around the spot Bitcoin ETF kind of fading a bit there, and then obviously the regulatory hurdles. Want to bring up a couple of individual movers though. Marathon Digital, if you look at that stock, MARA, is also lower. It's down about 5%, so on pace for its worst day since June 21st. Riot Platforms also lower, down about 3%, so also its worst day since June 24th. And then you do have Coinbase, COIN is the ticker symbol, is also down about 4%, Paul.
Yeah, I mean, I was looking at some of these moves here in the market, and Bitcoin got my attention because, first of all, Tom doesn't like to talk about it, so of course I raise it every opportunity. To me, I have no idea. So somebody tonight's going to ask me, as I'm sitting there with my pizza and beer at the Swan Tavern, what's going on with Bitcoin? I have nothing for them. Do you have anything? I mean, it's got
well,
nothing.
there's worries about selling, right? So
Yeah.
Mt. Gox, back in the day, now we understand it's moved to wallets, that sort of crypto that eventually will be given back to creditors. How much of that 8 billion will be sold? What then also of happening, the German government starting to offload some crypto that it too had taken hold of. So there's a lot of a supply side issue going on here, and that's why also the miners with the halving have been struggling in particular, and they're making less money off the mining process.
That's right, especially because, to Caroline's point, so German authorities, they are actually preparing to sell around 50,000 Bitcoin that they had seized earlier from online criminals. So you have that, and then to Caroline's point as well, when you're thinking about Mt. Gox, the sort of failed exchange there, they're returning about $8 billion worth of the hoard of Bitcoin to creditors, Paul.
There you go at the Swan.
That's
you
good enough for me.
You can give a few pearls of wisdom, Paul. Meanwhile, coming up, look, we're going out to a rather beautiful Aix-en-Provence economic conference going on. The former EU Commissioner Michel Barnier is going to be joining our own Caroline Conan. Tune in. This is Bloomberg.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders. From breakfast cereals to pet foods, General Mills has an iconic array of brands. But future success depends on efficiency, innovation, and insight. CFO Kofi Bruce does much more than crunch numbers.
Our first job is to intimately understand and anticipate the consumer's needs.
Watch Chief Future Officer. New episode Wednesday on Bloomberg Television.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
The private markets in general have exploded at the expense of the public markets. Part of that's regulatory, part of that's just structural in the market. Private credit particularly exploded when the banks took a step back.
Power, money, culture. Haslinda Aman tells the story of Asia's rise through the people who are helping to shape it. This week, with the drive of winning over a new generation of fans and players, Live Golf CEO Greg Norman is shaking up the game.
The best players in the world, on the best golf courses in the world, in the best cities in the world. It's very easy to get that multiplying factor to move out.
Latitude, encore presentation this weekend, only on Bloomberg. The top names in business are on Bloomberg.
What I can say is that we've been making significant investments across the franchise, across regulatory reporting, across data, and across resolution and recovery planning. These are areas we've been investing in because we know they're areas that, frankly, the industry likely needs to further enhance, and we certainly want to enhance them for ourselves.
Nobody covers business like Bloomberg. Context changes everything.
It is time to go out to the beautiful and rather warm Aix-en-Provence in southern France. There is an economic conference underway. This year's conference taking place in the backdrop, of course, of a key Sunday vote, a legislative vote. It's an election. And we head to the conference now. Former EU Commissioner for Brexit, Michel Barnier, joins our very own Caroline Conan. Take it away.
And I'm very happy to be joined by Michel Barnier from this economic conference in Aix-en-Provence. Former EU Commissioner, of course, and a negotiator for Brexit. Good afternoon, Michel Barnier.
Good afternoon.
First, one question on the UK. We had this outstanding victory of the Labour Party with Keir Starmer. Do you think this is the result of the bad consequences 8 years of Brexit?
Let me first congratulate Keir Starmer, the Lib Dems also, after the great victory. To be fair, I don't think that all the current difficulties of the UK, so
social difficulty, unemployment, inflation, and the change linked, thanks to the British people, to these difficulties. I don't think that all these difficulties are linked to the Brexit, but one point I'm sure of is that all these difficulties are more serious because of the Brexit, because it was a nonsense and a great illusion, to repeat the title of my book, for the Tory party to think that they will be stronger outside of the biggest free market, which is the single market of the EU.
We know the National Rally and many parties across Europe have now abandoned this idea of Frexit since Brexit. But still, in your book, The Great Illusion, you actually mention a warning to France about these problems of the government being out of touch with the population, the problem of immigration, the cost of living. Do you think what we're living right now in France has the same roots as the Brexit vote?
My answer is yes. And the reason why I called my first chapter in my book, the diary of the Brexit negotiations, a warning. I always try to respect the UK people and my counterpart to this negotiation. I have lots of admiration for the UK people for a long time, and I will not change. But I work a lot on the roots, the reasons why 52% of the British people vote against Europe 8 years ago. And when you look at the reason, at the roots, you can see many regions of the UK.
But let's talk about France now.
But the same roots as we can. What is this root in France now in many regions? Unemployment, bad public services. You look in France, when you look at 4 curbs which are parallel: the curb of the vote for the extreme right, for the far right, for the National Rally, the curb of unemployment, the curb of the distance of your house and the railway station, and the route and the curb of your house to a doctor. And these 4 curbs are parallel. So we have to tackle, we have to address, we have to understand what is in France the popular feeling, the social anger. The same roots are as in the UK 8 years ago.
What do you think a possible victory, because that's still possible, of the far right on Sunday? What do you think that would mean for the image of France abroad, for investors who want to put their money into France today?
First of all, it remains a few hours, 2 days, to draw the French lesson of the Brexit and not to do the same mistake as the UK 8 years before. So I think that we can avoid such a result and find a way to build a new majority in the parliament, even it will be difficult. To be frank, I think that the program of the far right is incredible. It's pro-Russian, anti-business and populist program, so it's the reason why I oppose firmly to this program.
The alternative to this is a hung parliament where possibly some technical figures are forming a wide coalition. Do you believe that's possible in France, and would you actually be willing to be part of this, to be part of a new wide coalition that includes the moderates from the left and from the right? And I remind our viewers that you are a moderate Republican.
Yes, but it's not useful to personalize the discussion. For the moment, we have to vote. Let the people vote in France. They are free, they are sovereign, and their vote will be important. And I don't know what will be this vote. On Sunday night, we will see exactly how many groups, how many members of the parliament in each group, and if it's possible to build something different from the far right. I don't know yet, but it's difficult to speak about the coalition before knowing the exact result of the elections.
But if President Macron calls you next week and offers you the job as Prime Minister, would you take it?
Once again, it's not useful to personalize. It's too soon, and we have to respect the vote of the people. First of all, the right sense. Let the people vote on Sunday.
Jordan Bardella, the National Rally president, has said he would refuse to become prime minister if he doesn't have an outright majority. Marine Le Pen, however, has been saying that she will try and grab those 15-20 lawmakers missing if she's just a few seats away. Do you think some of the moderate Republicans in your camp who might be elected on Sunday will actually join this possible National Rally Republican government?
I don't think so. I don't think so, because the people in our party who want to leave has already left with Mr. Ciotti a few weeks ago to join the far right. It's not my line, it's not our line, and all the other members will be elected. I hope a large number of members, perhaps 50 or 55, will be all elected against the far right. So don't ask them to join. No?
Do you think there will be, no matter who wins on Sunday, a sort of clash, showdown with the EU later down the road in the fall when we vote the budget on fiscal rules and on the budget?
Depending on what will be elected, what will be the majority. I think if we speak about a new alternative majority in France, my goal, my wish, my conviction is that the people who will have to work together must be on the European line. It is the blue line, the red line for us.
Finally, how big are the chances that in a few months or even in a few years from now we'll have Donald Trump in the US, Marine Le Pen in France, two populist governments on both sides of the Atlantic?
The worst is never sure. Huh? So we will see in France next Sunday. I think it's still possible to avoid the far right power, to keep a European line and a reasonable line for France, keeping its role in Europe, and we will see for the US. But anyway, what could happen in the US? What will be the next president? The lesson is very clear. What we are not ready to do for ourselves as Europeans, nobody will do for us.
Michel Barnier, thank you very much for joining us from Aix-en-Provence. One of the rare political figures present here in Aix at this economic conference, because none of the ministers from Macron's government is actually here these days.
Oh, interesting. Caroline Conan, thank you so much. We appreciate that. Caroline Conan with Michel Barnier, former EU commissioner in charge of the Brexit negotiations, which kind of comes back to my question. I guess we'll have to see what happens Sunday in France.
Yes.
But if I'm the EU, to what extent do I view the UK now differently than maybe I did yesterday?
More stability.
Yeah.
We have had what is a landslide election for the Labour Party, a Labour Party formed in the vision of Keir Starmer and very loyal to him.
Okay.
Even if perhaps not, he certainly said he's not going to unwind the Brexit vote. The UK emotionally could not tolerate it, let alone mentally. But I think we will see a more focused and clear-cut, less volatility. Look, they had too many people to try and negotiate with over the last few years.
Yes, and I'm interested in learning more about Keir Starmer going forward. And I think I speak for many Americans. We don't know really anything about him and what he wants his government to be, and maybe the to-do list, and then of course how they want that relationship with the EU to evolve. That's going to be fascinating to watch.
He actually grew up near where I grew up, and he formerly led the Crown Prosecution Service. He's a man of Whitehall, of government. We'll see what he brings to bear with his speeches today.
All right, very good. Looking at these markets here, the S&P is up 4 points. This is Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacroix, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
Jason Kelly, and this season on Power Players, we're taking you behind the scenes to see how the business of sports has gone global.
I want sports to grow. I want sports to be bigger because we have talent.
And how mammoth value is coming from the smallest of players. 3,184 hits, 431 home runs, and of course the most famous stat that everybody knows, 2,632 consecutive games played. Unmatched career. Why are you doing this?
we have achieved in the NWSL from an investor perspective over 2 years is the equivalent of what it took other leagues 25 to 30 years to achieve.
You've got to have a business that's sustainable. The only way it's sustainable is got to make money.
There's only one word: winning. You win on the court, you win off the court. And as you do that, you bring people along.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders. From breakfast cereals to pet foods, General Mills has an iconic array of brands. But future success depends on efficiency, innovation, and insight. CFO Kofi Bruce does much more than crunch numbers.
Our first job is to intimately understand and anticipate the consumer's needs.
Watch Chief Future Officer. New episode Wednesday on Bloomberg Television.
This is Bloomberg.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
The private markets in general have exploded at the expense of the public markets. Part of that's regulatory, part of that's just structural in the market. Private credit particularly exploded when the banks took a step back.
We welcome you to a July the 5th party here in Bloomberg, where we go radio, TV, simulcast to check in on the markets that are trying to party too. We've had some jobs data that seems to be enough of a Goldilocks scenario for the markets to factor in a Fed rate cut, and stocks go higher, bonds do well. We're also, though, seeing some release of tension in the UK and European trading. We still got the French election coming this weekend, but Jess Mentum can break it down from a markets perspective, a micro and macro perspective. Jess, what are you watching?
That's right. Well, especially on a weekly basis too, Caroline. So if you look at the S&P 500, up about more than 1%, and then the NASDAQ 100 up about 3% here too, going into this holiday shortened trading week. Though, if you look at the MOV function, some of the top percentage gainers here, AMD is one of the top performers, up close to 4% right now. If you look on the flip side of that, though, Micron Technology is one of the top decliners here, and that's continuing a string of losses when you're looking at that stock, down of 4 of the past 6 sessions, also down about 7% since it reported its latest earnings results in late June. Of course, we were talking about Bitcoin earlier since Tom Keene stepped out of the radio studio, so I'll give another update on that. You're looking at Bitcoin trading around 55,400, trading at its lowest level since February and lost about a quarter of its value since that record high back in March. And then also looking at individual stocks here for Right Platforms, down about 4%, Marathon Digital down close to 7%, and then of course Coinbase down about 5%. But I want to look at more of the gainers here, and especially when you're thinking about what's happening when it comes to department stores and specifically Macy's. So you are seeing that shares rising, actually up close to about 12%. We're on pace for its best day since March 4th of earlier this year. This does come after the Wall Street Journal did report a sweetened buyout offer. So the retailer is sort of shakeup happening in the department store industry, especially when you think about Amazon. But you have 2 investment groups that have increased their bids to take Macy's private here. So you have the Wall Street Journal reporting that Ark House Management and Bridgegate Capital Management have raised their buyout offers for the department store retailer to about $6.9 billion. So when you look at that stock, obviously, like I mentioned, on pace for its best day since March 4th. But you also have other department store retailers that are rising too. You have Nordstrom's, ticker symbol JWM on this, up close to about 2%. You also have Kohl's about 3% higher. And if you look at the sub-industry group in the S&P 500 for retailers right now, that's up about 3% this week, so on pace for its best week in about a month. Caroline and Paul.
All right, Jess Benton, thank you so much. We appreciate that. You know, you're just talking about the retailers. There was nice M&A activity taking place in the retail space. I wasn't really looking for this, but I guess it makes a lot of sense. Saks sealing a deal, $2.65 billion to buy Neiman. We're getting some help from Amazon. That's of note to me. Macy's shares rising on a Wall Street Journal report of a sweetened buyout offer there. So all of a sudden, we're getting some action in that part of the world. Let's check in with Andrea Felsted. She is a reporter in London. Andrea, what do you make of what we're seeing in the world of, I don't know, this high-end department store?
Exactly, and we're seeing a lot of excitement in department stores, and this is for various reasons. The first is the luxury sector. The US luxury sector had an amazing run after the pandemic. Everybody spent their stimulus checks, their crypto gains on Gucci handbags, Rolex watches. That's really slowed since. Plus, lots of share is going online generally, and we've also got the power of these big brands like LVMH, which owns Louis Vuitton and Dior. So all of these things are coalescing around the need for the department stores to really bulk up.
What's interesting is whether or not, therefore, we see consolidation and, therefore, fewer bricks and mortar options. I mean, will we start to see them pull back? That's what ultimately consolidation should do. They want to be cutting their costs. They want to be leaning into more operating efficiency. Is that what we're going to see?
That is certainly possible. They haven't talked about store closures yet, but of course that can't be ruled out. Macy's is closing stores anyway, although it's growing its luxury arm.
Andrea, what was really interesting to me, at least, was that Amazon playing a role here, putting and Salesforce, for that matter. What's the role of some of these tech giants here in this transaction? What's the angle?
Well, Amazon's long tried to get into luxury fashion, and it hasn't really worked out. Brands have been reluctant. I mean, Louis Vuitton, Dior, they're never going to sell through Amazon. But other brands have been reluctant to get involved because, they sell much cheaper goods, and you want your, you want your expensive handbags to be in that kind of environment. But this gives them another way into luxury fashion, and it could help build their credibility in this sector. At the same time, we've had real turmoil in the online luxury fashion sector. We had Farfetch sold, Matches collapse, Net-a-Porter's up for sale. So this might be a moment, some second-tier brands that perhaps sold through these platforms might be willing to try another option, and that might be Amazon.
I'm really interested more broadly. So we've got Macy's reports from Wall Street Journal, of course, the Arc House Management, Brigade Capital, looking at sweetening their offer. The combination of Saks coming together with Neiman Marcus. What does it tell us about the US consumer? Because I thought, speaking to the CEO of Amex every now and then, or talking to some of these high-end luxury purchasers, that actually the ultra-wealthy were still ultra-wealthy, and they're still spending as they always have been. Who is pinched right now? Why is there such pressure? Who is not getting their money from their crypto anymore or their stimulus checks?
It's not the super wealthy. They're still spending. It's the sort of what we call the aspirational luxury consumer. So not super wealthy, more comfortable. And it's that cohort that has really been hurt by inflation and by higher borrowing costs. And they are the ones that are cutting back. So the more exposure you have to that sector, the more troubled you are. And that is exactly the sector that these department stores play in.
Andrea Felsted and Bloomberg Opinion, it's always a joy to have you join. Thank you very much indeed. Go have a restful weekend in the UK. Meanwhile, look, maybe that pinching in the middle at the moment, Paul, is exactly what we might see reflected when you're thinking about a vacation at the moment. Where are you putting your bang for your buck? Is it about experiences? Are you still going for the ultra-luxury holiday and hotel, or are you trading down a little bit? We've got the perfect person to be asking this at the moment. Robin Harris is with us. He's CFO of Trivago. Look, it is the #1 global hotel search platform. And look, many people, 71 million, in fact, Americans are meant to be hitting the road this 4th of July weekend, Robin, according to AAA. How many of them are still really spoiling themselves on a hotel, or are they trading down?
Hi, Hi, great to be speaking to you. What we see on external data is that this year 5% more Americans are traveling on the 4th of July. And when we look at Google, there we also see higher travel demand. And our internal data shows that the top destinations this year are the same top destinations that we saw in 23. And however, the prices went up sometimes significantly. So the top destinations are number one is Las Vegas, number two is Myrtle Beach, and the third one is New York. And prices in Las Vegas and in New York are up quite a lot. So, and therefore it makes a lot of sense to compare prices on Trivago.
I can tell you a lot of people are going to the Jersey Shore as well, judging by the beach yesterday. Robin, globally speaking, is travel these days, is it mostly within one's own country, or where are we in terms of international travel?
Yeah, so most of the Americans travel within America. Yeah, so most of the travel, and we also see this on other platforms internationally, that the domestic travel is strongest. So, but of course, you also have many Americans that go to Mexico, that go to Italy or to Spain or to Turkey, also strong. But most of them are travel within the US.
How much have people been trying to navigate the inflationary pressure of, look, as someone who has kids, I started to use an Airbnb experience, or at least some sort of home that I was going to go and stay in rather than a hotel, purely because I needed a microwave. I needed to be like doing milk, this, that, and the other. I needed to be cooking kids' food that I didn't want to spend an absolute fortune on. But how much has that factored into what people are looking to and for from a hotel experience? How much are we starting to see some of the cleaning fees that you see within an Airbnb fight back, and people are now wanting the hotel experience? What do you see, Robin?
So Trivago is pretty much focused on hotel. So we offer over 5 million hotels and other accommodations, so which are also apartments. So, but we are pretty much focused on hotel, and so we see a huge opportunity even in the hotel segment, and we see that the demand is strong for people searching for hotels and going to hotels.
Robin, talk to us about business travel. Where are we in terms of maybe pre-pandemic levels in terms of business travel? It seems to come back. I'm just not sure where we are.
No, so we are already back. I think so when we look at the seasonality and when we look into the demand for this summer, it's high. Yeah. So and it's compared to pre-COVID, it's, I think, even higher. So the demand is healthy. When you look into the market, it's healthy. So this looks all very stable and solid.
What's interesting, Robin, is the US dollar has been doing mighty fine versus basically everything else of late. And I would have thought that you mentioned Turkey, you mentioned Europe, Spain. I know many are going to Portugal, for example. People looking at Japan, finally, because it seems to be so much more economical from an FX perspective. Has that in any way changed the way in which a US traveler is looking at opportunities to go globally travel rather than keep it domestic?
So we see that the Americans, that they stay more in the US and go less abroad. So the domestic travel has been increasing, and this is also a trend that we see that, or we observe that that people go more for mid-star hotels instead of high-class hotels.
Robin, if I wanted to make a last-minute decision and go over to Paris for the Olympics, can you get me a room, and how much do I have to pay for it?
Yeah, so this might be expensive. Yeah, so, but of course we will find a good offer for you, and it makes sense probably to go a little bit outside of the top destinations. Yeah, because it's what we see. Travel trends are that whenever there are sporting events or even concerts, big concerts, that prices go up a lot. So therefore, it might make sense to go a little bit outside.
I mean, it was cheaper to basically fly over from America, take your family to Europe, watch Swift there, and then fly back again, than to watch it in America.
Exactly.
Robin, I'm really interested in Trivago in and of itself, because you are bringing price transparency. Look, there are so many ways in which I could buy a hotel, whether I'm going direct to the hotel's own website, whether I'm doing it sort of via various agencies, and you're trying to honestly get rid of some of the arbitrage issues that we currently face and get us the best price. How much are we seeing a murky price point for hotels? How much clarity are we able to get that there's just one true price?
So when you compare today with pre-COVID, you can see that there is more price disparity, and you can see that there are more different rates across the hotels out there. So therefore, it still makes a lot of sense to compare prices, and it makes even more sense than pre-COVID. So, and I mean, that's the market. Yeah, you see there are different prices, and it makes sense to compare it, and that's what we are doing.
Robin, are all the hotel chains notable? I mean, even the high-end ones, are they open to doing business with the Trivagos of the world?
Yes, we have most of the big global hotel brands are integrated and are our partners. And if you go to Trivago, you can also see the direct prices from the big hotel chains.
All right, Robin Harris, thank you so much for joining us. Robert Harris, Trivago CFO. Talk to us about travel. Vegas, Myrtle Beach, and New York. Have you been to Las Vegas?
Only for work.
Only for work.
I need to go for pleasure.
Yeah, but not the kids. We'll leave the kids.
Yeah.
Have you been to Myrtle Beach?
No, do tell me. Should I?
Fun. Yeah, the kids would like it.
Okay.
It's a lot of fun. It's lower cost, so it's probably one of the best values beach-wise. Just throwing it out there. It can get a little rowdy, so you might want to find
so spring break ain't the time to go?
No, I don't think you want to go spring break. But then, you know what? I still tell people, if you're coming to the States, and I'm going to stick with this call, take 3 or 4 days at least for the Bay Area. San Francisco, the whole, and the Silicon Valley, and then going up to Napa. Yes, the headline risk has been kind of bad for San Francisco for the last several years, but still, I tell people that are my European buddies that are coming over for 2 or 3 weeks, take 3 or 4 days for the Bay Area.
You don't need to go and stay on Market Street.
No, exactly.
And ultimately, that is where the pain, the pressure has been. But to go and travel that part of the world, I luckily lived there for 6 months.
Yep.
Amazing.
Yep, it's great stuff out there, and maybe go down to Monterey Bay, Monterey Peninsula. That's also nice down there.
They've got a good aquarium.
Yes, they have a great aquarium, of which I spent probably 20 years there. Coming up, this is Bloomberg.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. Money, culture. Haslinda Aman tells the story of Asia's rise through the people who are helping to shape it. This week, with the drive of winning over a new generation of fans and players, Live Golf CEO Greg Norman is shaking up the game.
The best players in the world, on the best golf courses in the world, in the best cities in the world. It's very easy to get that multiplying factor to move out.
Latitude, encore presentation this weekend, only on Bloomberg. The top names in business are on Bloomberg.
What I can say is that we've been making significant investments across the franchise, across regulatory reporting, across data, and across resolution and recovery planning. These are areas we've been investing in because we know they're areas that, frankly, the industry likely needs to further enhance, and we certainly want to enhance them for ourselves.
Nobody covers business like Bloomberg. Context changes everything.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacroix, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
We can make a start today with the simple acknowledgement that public service is a privilege. From now on, you have a government unburdened by doctrine, guided only by the determination to serve your interest, to defy, quietly, those who have written our country off. You have given us a clear mandate, and we will use it to deliver change.
And change it is after 14 years of a Conservative government in the UK. Labour has won by a landslide. That, of course, was the leader, Keir Starmer, as he becomes Prime Minister, standing outside number 10, with his party winning more than 400 seats in Parliament. Look, it's the biggest majority since when Tony Blair swept to leadership in 1997. Here with us is Bloomberg's acting London bureau chief, Anna Edwards, well-known anchor as well across our network. And what's interesting is the first past the post method of voting in. This looks like a landslide. It seems like a landslide. The mandate is there, but is it truly from the amount of people that turned out and voted?
Yeah, hi, Caroline. Yes, the mandate is there in the sense that he has his hands on the levers of power. More than 400 seats in a 650-seat chamber, as you described, gives him a lot of power. And yes, you can point to the low turnout, and you can point out that his vote share didn't increase that much from 2019, but that's how the UK system works. And so he has this landslide victory, and therefore he has the power to do the change he wants. He's trying to pitch a message of optimism, talking about hope a lot, talking about public service a lot, and you will know, anyone who's watched the UK scene will know that there's been a lot of distraction and a lot of scandal around UK politics and a lot of change of leadership, and so he's certainly pledging something of a tone shift and a different way of operating. Big challenges for the UK economy, fiscally limited. Growth is the big focus for this new government, we understand, and already, new Prime Minister, day one, putting together his new team, has already announced who is going to be the new UK Chancellor of the Exchequer, so like the Finance Minister or Treasury Secretary in the United States, and that is a new name perhaps for the US audience, Rachel Reeves. She once worked at the Bank of England, so she comes with a lot of experience at the City of London, and she's the first female Chancellor of the Exchequer that we've had in this country.
And I watched and listened to Keir Starmer's speech this morning, and I think I probably speak for most Americans in that he seemed like a reasonable person. His comments seemed to be reasonable, open to negotiation, compromise, getting things done. Is that a fair read here, or am I just rose-colored glasses?
Right, yeah, he's an interesting character because he's a very experienced operator. He comes from the Crown Prosecution Service. So basically, that's why he is actually Sir Keir Starmer. He was knighted many years ago. He plays that down, not because he wants to hide it, but because he doesn't want that to suggest he came from privilege, because he, as he told us many times in the campaign trail, my dad was working class, my dad was a tool maker, was the classic line he gave. And so he likes to remind us of his sort of humble background. And he is very much a public servant. He talked many times today about public service, about representing the people in ways that perhaps would resonate with a US audience. And that's obviously something that is very important to him. He lacks perhaps some of the showmanship and some of the drama that we've known from other leaders in UK politics. But after the Boris Johnson era and Liz Truss and Rishi Sunak and that revolving door of Conservative leaders that we've seen go through